Good morning, ladies and gentlemen, and welcome to the Risk Management Conclave of Sa-Dhan. I'll request Mr. Gigi Mammon, ED and CEO of Sa-Dhan, to come on the dais. I will also request Mr. Ravi Mohan, Chairman of ISAF Small Finance Bank and former CGM of RBI, to join us on the dais with Gigi sir. I will now request Mr. Gigi sir to start the program with his welcome address.
Good morning to all. Respected Ravi Mohan ji, ex-CGM of Reserve Bank of India, an officer from the IMF, and presently the chair of ISAF Bank, senior colleagues from the sector, my dear friends, ladies and gentlemen. It gives me a lot of pleasure to welcome all of you to this conference, it's a conclave on risk management. I'm really happy to see a full house today. We have more than 100 participants in this room. It's really very heartwarming to see so many persons from different states, different institutions assembled here. But we were a little apprehensive when we fixed up this venue, whether people would be able to join us in this number, because we know that Kochi is a little away from the center of all the activities. But in spite of that, I am happy to see so many people here. I welcome each one of you for this conclave, and thank you for sparing your time. Risk management is an important topic, and as a lender, it's very important. For any lending institution, risk is unavoidable thing. You can't eliminate risk, but you can minimize risk. So that is the reason why it's called risk management. Basically, it's managing the risk. It's said that lending is a business of managing the risk. How better you manage the risk, you can do better. When you see the risk, we have three types of risk, we all know. We have credit risk, market risk, and operational risk. Credit risk is the primary thing, because as a lender, as a lending institution, you're dealing with lending and collecting. The risk is more there, especially in a sector like microfinance, where the lending is done on non-collateralized way. The risk can be more. But then we can also reduce the risk, even in microfinance, even in a non-collateralized lending. If you do the right kind of appraisal, right kind of follow-up, right kind of collection process, I'm sure the risk can be reduced. Many times, the appraisal itself gets faulty and the risk goes up. Especially in a scenario where we are now going through. I have been seeing that there is a slight increase in the credit risk happening. In fact, the recent report published by ICRA, it also talks about the higher credit cost in microfinance sector and increasing trend. Probably it will settle down in another 1 or 2 quarters. Last 2-3 quarters we had been seeing slight increase happening. There are several reasons for that, and one of the reasons is that the turnaround in the HR. we have been seeing a lot of attritions happening in the HR sector, HR side. In microfinance sector, the attrition level have really gone up. Of course, across the board, you can see the attrition happening in different industries. But then microfinance, I have been watching that the attrition has gone up. But last year, we did a similar conclave in Chennai on HR, where this issue was very prominently discussed. And based on that discussions, we have instituted one study. And that study report is under finalization. We were looking at what is the reason for this so much, so large attrition happening in the sector. When you say attrition, it's more than 60% in the industry as a whole. And in some institutions, I have seen more than 100%. I'm not joking. I have seen an institution with more than 100% attrition happening. So that means every field officer gets turned around. So what is the reason for this attrition and how to reduce it? This was our study, and it was shown a lot of course, insights from, we could get a lot of insights from that. Of course, since it is not finalized, I am not able to come out with all the observations. But one of the observations I just wanted to flag here, which is very important. It says that around 40% of the people who live as MFIs do not have a job at their hand. It is really surprising because many a times we think that people leave the organization because they are getting a better job somewhere else or they are getting a little higher pay somewhere else. It is not so. So there is something wrong. We need to introspect. In fact, we have convened a meeting of the HR heads just to discuss this report before it is finalized in this week, and probably next week we are also presenting before the CEOs, some of the CEOs, before it is finalized. So what I try to say is that when you have more attritions, it adds to the risk. A newer person coming into the field may not be able to continue the same kind of effectiveness as the existing person who had initiated the loan and who had been doing that. So credit risk is not only limited to the appraisal or the follow-up or the collection process. It also depends on retaining the staff. As far as market risk is concerned, mainly it relates to the liquidity risk or the interest rate risk. It's not much, I would say, in microfinance. It is manageable. It is more of a thing which not very prominent as far as the sector is concerned. But the third one is very important, the operational risk. And I find that operational risk is much more prominent than the credit risk in microfinance. And this happens not only because of the internal issues, it also happens with the external factors also. We have been seeing in the sector, any small campaign here and there causes the problem. So external elements can cause a risk to the institution, to the microfinance sector. So how to ward off that? How to ward off the internal the operational risk elements, like your staff actions and omissions and commissions of the staff. Many times, it's a very, very sensitive sector, we all know. It's a very vulnerable sector. Media has a lot of attention on this sector. Anything going small, any small things going wrong, that can become a big story and it can cause a lot of damage. So external risk is much more higher, I feel, than the internal risk in operational side. So these are some of the things we had been facing. So we thought that we need to discuss on this. We need to come out with some kind of a concrete actions. How do we minimize the risk? How do we reduce the risk? And how do we do a better job as far as our sector is concerned? That's the reason we thought of having this conclave today here. I'm really happy to see all of you coming here. I'm sure today's deliberation is going to be an eye-opener and it will help us to take this sector in a much better way. We have to make risk management a kind of I would say kind of a habit or kind of a plan for the entire staff. It is not limited to the risk management team. Risk management team, of course, will lead the risk management, but it has to become a part of everyone in this sector, everyone who is working in the sector. So let's hope that today's deliberation will help us in achieving that. I would expect, of course, we have 3 panels discussing on the 3 different topics which have been already circulated to you. We will be getting a lot of insights from them, but then we will also expect each one of you to contribute so that we can come out with better action points. So with this, I once again welcome each one of you, and especially I thank Ravi Mohan Saab for being here. You know, Ravi Mohan Saab, as a long career in Reserve Bank of India, has been also an expert in risk management. So he would be able to give us a lot of insights about the risk management. And I welcome each one of you, and with this I hope to see a better deliberation and better discussions happening today. Thank you so much.
Thank you, sir. Now I will request Mr. Ravi Mohan to deliver his inaugural address.
Good morning to all of you. Mr. Gigi Maman, ED and CEO of Sa-Dhan, the speakers and the panelists for this very topical conclave, and participants who have come from microfinance institutions, small finance banks and commercial banks. It's a great pleasure to be part of this conclave on risk management in microfinance organized by Sa-Dhan today. I'm quite happy that despite the weather conditions being what it is in Kerala these days, so there has been a huge participation, I will say. Risk management is something which is very close to the heart of all of us. I will make 2 small, I will not say corrections, but 2 small additions to what Gigi said in his opening remarks. One is that, he said that risk management has to be part of everyone. I will use a term, you have to internalize risk management. That will be a better word, Internalize risk management is the same thing that he said, but it has to percolate. There is no point in risk management being with the risk management committee of the board or, at the head office with the risk management department. It should basically go down to the teller who is sitting in the counter and giving money to somebody. He should know what risk management is. And the person who is interviewing a customer, he should know what risk management is. That is the internalization of risk management. And second thing is, Gigi also said that we should try to minimize risk. But I will say that it should be to optimize risk, because there is a problem with risk. What is risk? Let me start with the most fundamental statement that all of life is management of risk, is it not? And today morning when we get up, the first thing that I thought is, what will be the traffic in Seaport Airport Road? That is my first concern. So, whether there is a risk in, traveling and reaching here in time. So all of you would have experienced that, traveling from different part of Ernakulam city or, from different places. Other than those who come by flight, all of us have the traffic in front of us. That's the first risk. Second risk is, as once you reach here, you do not know what type of speakers are there, what type of panels are there, whether there is a risk in listening to them or not. So that is a second risk. And then whether Gigi has arranged a nice lunch or tea or, the third risk. So, all of life is management of risk. And the last risk is, once we go back home, what is going to happen at home, all of you are sitting in air-conditioned room and enjoying the seminar. Once you reach there, the spouse will be there, really angry that the entire day you have been here, have not even spoken once on mobile, So there is risk in all part of life. So basically, there is a classic definition that risk is, something unpleasant to happen. That is what Oxford Dictionary defines risk as. So naturally, there is a very close relationship between risk and the return that we are getting, and we know that this statistics gives us all these principles. There is this famous Markowitz principle which says that higher the risk that we take, greater will be the return. But we cannot keep on taking risk beyond a particular point, is it not? So, but we cannot minimize the risk also. If we minimize the risk, naturally the return also will be low, because as an institution which is catering to the public deposits, and also you have to generate enough return to service that. So naturally the most better terminology will be how we can optimize risk. How we can optimize risk. That means, we do not want to reduce risk beyond a point, but at the same time we do not want to increase the risk. So how can we have a management between the risk and the reward? That is one of the most important challenges that all of us face. So I will say optimizing risk will be the most important challenge. So I'm sure that in this conclave we are talking about the risk management, the operational risk, and the role of IT or in technology in risk. These are all very important issues, and the three panels which are going to deliberate, I'm sure, will come up with a lot of insightful information for all of us. But let me say that most important type of what type of risk that we face is also I think determined by what is happening in the environment. If you look at the environment in the last few years, I am not talking much behind when the global financial crisis happened and there was a lot of pressure on credit risk, market risk, operational risk, everything. But if you look in recent times, so during the last few years we have been again faced with a lot of challenges. I am talking about the financial sector and the banking sector in general. It started with the pandemic, the COVID-19. So the COVID-19 affected all of us, as you know. It affected the lives and the livelihood of people. But when we say that the COVID-19 affected all the sector, the banking sector, the financial sector, the pressure was much more on microfinance institutions and small finance banks and institutions like that, as compared to a large public sector bank or a large private sector bank. That is basically because as institutions we deal with the people at the lowest rank of the pyramid, is it not? So our people, the customers that we deal with, these were the people who immediately lost their jobs, who immediately lost everything during COVID. And of course there were a lot of support measures. We gave moratorium, we gave some relaxation. But these moratorium and relaxation on the one hand tries to help people, but on the other hand, for a lender, it creates a moral hazard. It creates a moral hazard in the sense that if you tell the people who are at the bottommost part of the pyramid that for 6 months you need not pay back, and there is a feeling that gets into them that they need not pay back. And there are umpteen number of people outside our category who keep on telling them that these loans are not to be paid back. After all, this is the government funds. So all these things. So once people don't repay for 6 months or so, then it becomes very difficult to imbibe the culture of paying back. So this was one of the things. And after somehow COVID effect came down, we had all this geopolitical tension, the Ukraine war and the Middle East war. Even though it did not affect us to that extent, but that geopolitical tensions are something which always affects most of the countries, because we have some trade relations and things like that, remittances, whatnot. And now, after these two things, you all know that in 2023 there was this crisis in US and Switzerland where all the Silicon Valley Bank and banks which were supervised relatively supposed to be much better than emerging market countries, they got into complacency, I will say, and basically market risk and governance issues. So this created again lot of ripples in the financial sector. Fortunately, India did not get too much affected because our exposure to these banks and the startups they were financing was not much. But basically, all these things will have an impact on the sector in which we are working, even though some of them may be direct, some of them may not be direct. But we are also, since we are in the same part of the structure, so we cannot avoid that. So risk management basically is something which deals with all these things. So I would like to say that in risk management, the most important thing is you have to identify the risk, you have to measure the risk, you have to manage it. Manage it means you have to either control it or mitigate it to some extent and then report it. So these are the 5 or 6 stages in risk management. So whatever type of risk that you talk about, all these are very relevant. And in our case, when we are dealing with the sector in which you deal with, the most important risk is credit risk, like Gigi spoke in the beginning. And credit risk, as all of you know, is the risk associated with counterparty failure. You give a loan to somebody and he doesn't pay back, and that is credit risk. And perhaps this is the most simplest definition of credit risk. And credit risk management is also very simple. You can say that there are three modes of managing credit risk. We call it as, you must have studied it in textbook and in all other places: selection, limitation, diversification, and that's all. Is it not? Selection, limitation, diversification, and that's all. Selection means you select a customer appropriately, all your financial assessment and due diligence and what all you say. And then limitation is that you have all these, exposure limits and all. You don't lend more than a particular level to a particular person. And diversification is various industries, various collateral, various geographical locations, etc. So if you do these 3 things, naturally the credit risk will be managed. This is the textbook management of credit risk. But in real life, it doesn't happen. That's a sad part. Because credit risk has got a lot of other associated risks like concentration risk, the risk associated with collateral. All these things are part of credit risk, but you do not have a ready-made thing for covering that. And then, as you know, the portfolio risk getting over, the interaction between different portfolios that you have in your credit management system, all these things can aggravate credit risk beyond a particular point. So in risk management, we also look at if you look at the credit risk management as of now, we have different things which are coming into picture. One is the concept of risk appetite. The second is the concept of risk culture. The third is the concept of all this risk tolerance and the various limits that are associated with that. So basically what it means is, as we said, that risk is uncertainty, or risk is something unpleasant to happen. Risk is the uncertainty regarding the return that a lender or an investor has by holding a claim. These are all classic definitions of risk. And we all know that risk cannot be measured precisely, is it not? If we could measure risk precisely, I am sure that none of us will be sitting inside this room. We will be making a lot of money outside. But unfortunately, we cannot do that. But then statistics helps us to give an estimation of risk. There are statistical techniques and tools for measuring risk. You all know all this standard deviation, mean, median, mode and all, which you might have studied many years before. And that has become very important now after the crisis and all, because people have got a lot of modeling for risk and all, which are based on the statistical principles. So as a result, the risk management puts a lot of emphasis on what is the risk appetite of an organization. So if you look at the risk appetite statement of many banks, which is part of their Pillar 2 process, the ICAP and the SREP, which as microfinance institutions you are not subjected to that rigor, but commercial banks and small finance banks have to look after this Basel implementation, their Pillar 2, the risk appetite statements. We will find that the risk appetite statement is a qualitative statement. It says how much risk that an organization would like to take. So, you would like to say that, okay, many organizations in their risk appetite statement say that our strategy in risk appetite is to ensure that we take minimum risk or something like that. But that doesn't convey anything. So it would have to be broken down into risk tolerance limits, or various type of limits, and see how these limits are managed and maintained by organizations. And all this put together becomes the risk culture. What is the risk culture of an organization? So it is a sum total of the statement by means of which an organization manages its risk, tries to assess and measure the risk to a reasonable extent, has got various limits and how does it try to abide by these risk requirements and all. And then you have this oversight function, which is again very important from an organization's perspective. What we call by oversight is risk management, compliance, and internal audit put together. We call it as the oversight function, while it is the role of the board. But each of you who are working in many of these departments which are concerned, including an HR department, you have an important role in ensuring that these oversight functions are complied with. And oversight function, risk management has got a very important thing. And I will also like to mention about something which you will find in the risk management literature very prominently, but which has again become very important now. That is about this 3 lines of defense model. You must have heard about that. This is again something which is very critical in risk management, whether it is operational risk or credit risk or any type of risk. So basically what it means is there are 3 lines of defense in risk management. The first line is the business unit. I'll give a small example. Let us take the example of a teller giving cash to somebody. This teller sitting in the counter is the first line of defense, because he decides when a check comes whether this money has to be given or not. And he looks after all the process and procedure, how a check can be passed and money can be given to somebody. So this is the first line of defense. The second line of defense is the risk management function for the entire organization, which covered the teller, the manager, everybody. And the third line of defense is the internal audit, which sees whether the first line of defense, the teller, the second line of defense, whether the risk management function, they are complying with all the requirements properly or not. So if we have these 3 functions which are managing very properly, then the risk management will be quite effective. And I would also like to mention one more term to you. This has again become very important in risk management now, especially during the COVID period. And this is the terminology called resilience. So now everybody talks about resilience. You must have seen that the Basel Committee has come out with a paper on operational resilience in 2021 March. So, the focus on this is that, what do you mean by resilience? I mean, operational resilience, to start with. Operational resilience means how an organization can conduct its critical operations in the face of a crisis. That means just take any of us, or a bank or a small finance bank. Most critical function is accepting deposits and paying the depositors back, is it not? So in disruptive environment, how can you ensure that your ATMs are filled with cash? So that somebody comes, he has to, because branch may not be even open, because if there is a lockdown or something like that. But how the ATM works, whether there is cash in ATM, you are able to fill it up. And if somebody wants to open an account, whether you are able to do that online. So it involves a lot of other risks. I will come to that. So operational resilience is something which is very important, and associated with that is resilience in all other parts, in credit, in market risk, in every other part. But resilience has become the most important part of risk management now. And people now these days don't talk about the risk. They talk about the resilience more than the risk. Because resilience is something which, we say that the Indian banking sector is very resilient, is it not? That is basically our banking sector or our financial sector has been able to manage the risk involved in most of these things, to a considerable extent. Maybe because our regulations and supervisions are very strict and rigorous, maybe because we have lot of self-regulatory organizations like Sa-Dhan for this sector, the IBA for the banking sector, and FIMDA for the market sector, FEDI for the foreign exchange sector. And most of our self-regulatory organizations have been very, very, very empowered type of organizations. And this is a difference that India has got with many emerging markets, that we have given lot of freedom to these self-regulatory organizations, and they are able to manage the situation considerably. The regulations and the regulatory processes are very tight. I still remember that when these derivatives came to the market, and at that time I was in the regulate Department of Banking Operations and Development, which were controlling all these things. And Dr. Reddy was the governor. Dr. Reddy was, he was a very hands-on type of governor. He said that we should not allow all these derivatives to be used by the customers unless they have that much knowledge. Okay. So we issued some circular saying that derivatives are not permitted. We issued a circular called suitability and appropriateness. That means, if you are selling a derivative to a customer, you should get a declaration that he has understood what that product is, etc. But you know how banks take this statement. I need not tell you. I myself was the supervisor for a long time. So the classic example was in Tirupur. Tirupur is a place where all these what do you call the banyan and all these textile manufacturing things are there. So Tirupur, there were a lot of manufacturers who were exporting to some parts of Europe. They were manufacturing these clothes and they were exporting. So some bright foreign bank chap went to them and said that, hey, why don't you get into some of these derivatives? So these exporters said, what derivatives? He said, no, you don't do anything. You just sign, and you are getting some money in US dollar. So you swap it into Swiss franc and, you will get lot of money. So some of these people, they thought, that's a good idea, So they got into these derivatives and initially they got lot of money. And then ultimately this cross currency swaps and all. It depends on the exchange rate between US dollar and Swiss franc. And it can change the other way at the shortest possible notice. Something happening in Switzerland or something happening in US can upset this. And then they started losing money. So when they started losing money, they all came to the Reserve Bank and said that, please give us our money back. So we asked, when you got money, you never came to us. When you lose money, now you are coming. Then they filed a case in the Supreme Court. And the Supreme Court made RBI also a party to that. So we showed our circular and said that, read this suitability and appropriateness. So the court dismissed the case. Poor fellows, they lost a lot of money. So that is why, sometimes you feel that this risk management can have a lot of other ramifications. That means if you do not know a product and you get into that, and then you have. But fortunately for us, the sector that we are operating, we are not faced with these type of things, because our most important thing is the credit risk, as Gigi said in the opening remarks. Because two things. One is that we are dealing with people who are at the bottom of the pyramid, and these people are affected by anything. Even it rains 3 days continuously, they are not able to go for work. Your collections are coming down. Then, then there is a backlog, and this becomes, our portfolio becomes risky. So it's a big challenge for us. But I am sure that without us, many of these people would not have got any finance, because their chances of getting a finance from higher organizations are very limited. And second thing is, they want money quite fast, and microfinance institutions are capable of processing these very quickly. And you all have the concept of group lending, where the peer pressure puts lot of pressure on people to pay back the money. So, but from this perspective, our credit risk management becomes the most important thing for us. And how do we do that? Again, that classic formula is selection, limitation, diversification. But then beyond that, we have to apply our mind. We have to look into the sector very carefully. And and all of you know that recently these two guardrails have been put by Sa-Dhan and MFIN together. So these at least help. But that has created a problem. Paul was telling me that in many of the Sangam meetings, they are saying that I have been paying back my money, but how have you reduced my eligibility now? So this is another challenge that all of you will face answering, to them. But, at some times when times are very hard, we may have to take some decisions which are little tough on us. The other day, we were doing a seminar in one of the colleges nearby in St. Paul's, Kalamassery, for the students of commerce and finance on an international, a global seminar. So I was talking about risk management. I was telling them that there are these traditional risks like credit risk, market risk, operational risk and all. And there are also these high-end risks which are again some of them are generated from operational risk, like the cyber risk, the money laundering risk. These are all part of operational risk. But then they have all become separate risks in their own rights now. Because that the number of cyber incidents which are happening, and the number of the threats which are happening, and for us that's a very important thing, because from an operational risk perspective, we may not be affected by cyber risk in many of our customers, but there is a chance that many of these people who are not that literate, they may give their ATM card to the collection agent or something like that. That fellow can take the money. Amounts may be small, but the reputation risk that comes to our organizations are very, 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 very serious. So there is a need for us to make awareness among the people, awareness among the staff working with us, to ensure that these type of IT related or technology related frauds are coming lesser and lesser for us, so that even though the amount and the involvement may be much limited, but it can create a much serious supervisory risk. And lastly, as all of you know, there is a concept of this ESG risk, this environment, social and governance risk. Environment risk is something again which is very critical. May not be to that extent for the microfinance institutions, but it is coming for us also, because it depends on how much the climate risk is there. Now all of you know that the climate has totally changed, and we are in September, and look at the rains in Kerala. It used to be June and July when it used to rain very, very, very heavy. Now June and July is dry months, and August, September have become, very, very heavy, serious rains. And this affects the crops, the cropping pattern, and this is happening all over India, all over the world. So how do we look at climate risk? Because our customers or our clientele are mostly people who are engaged in agriculture operations, is it not? Agriculture and allied operations. So any serious impact on the climate risk will be felt by us first, even though we are at the lowest rung, because our clientele will be affected. So climate risk management is again a much bigger issue. It has to be with the involvement of the governments across the world and all, to contain the carbon emission and try to look at environment, protect the forests and things like that. These are all things beyond us in a classroom, but at least the limited point is that it gives lot of impact on us. And the last one is the technology related thing. I spoke about this. All of you must have been receiving a lot of mail or messages these days, is it not? And the messages keep on changing. Earlier it was that your KYC requirement, there is a problem, and if you don't click this link, your account will be frozen, is it not? That was the first time. Then many people would have fallen prey to that, but then they are very smart. Now the message, then the message changed, saying that you send a parcel and in your parcel drugs were detected, right? So immediately, unless you contact, and there is a virtual police station and all, you ask them to click the video, and the video comes, then the police station appears, and one fellow says that you are under virtual arrest. You won't believe. I thought that people don't fall prey to this. But day before yesterday, the branch manager of one of the large private sector banks in India came home for something, and he was telling a real life incident which I want to tell you before I conclude. So he said that a old lady, a retired professor, came to the branch and said that she has got 25 lakhs in FD. She said this 25 lakhs has to be transferred to another account, close my FD and transfer this money to another account, and she gave some account number. So the counter staff was little amazed. 25 lakhs, one step closing and transferring to another account. Why do you require that? She was not telling anything. She said this has to be done immediately, and her hands were trembling. So she called the manager, and the manager came and asked her why. She said, no, it is very urgent, very urgent, very urgent. So, and her mobile was there, she was not leaving the mobile. So he says, I snatched the mobile from there, and somebody was on the line. And when he spoke, he said, no, you are under virtual arrest. Unless you transfer this money within the next half an hour, you cannot, move, and the police will come and all these things. Educated person, and she didn't tell anybody in her house, neither her husband nor her children. She got so frightened. So this is the way in which these people are operating. So in our case, even though we are working with the smaller institutions, the amounts may be small, but this type of frauds are happening, and people keep clicking the link, people keep on answering the phone, and these type of what do I say? Operational risk has become very, 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 very serious now. So we have to think about, I'm sure that you have discussion on use of technology in risk management and also on operational risk. I'm sure that you will come across many things. But I will say the most important thing in risk management is to spread the awareness. Spread the awareness among our staff and spread the awareness among the customers with whom they interact. It should be a good idea that in banks and larger microfinance institutions, once in a while you should have a conclave or you should have a meeting within the branch where you call the customers and try to educate them on these things. And you must have seen that this Reserve Bank of India has got a very nice publication in the form of cartoons. This Raju and the money tree and all those things. You must have seen that. This gives a lot of information about the risk and related issues. So these type of things, and whenever you do some financial inclusion like meetings, please make it a point to tell people about what type of operational risk issues can come, and at the same time also talk to them about the credit risk concerns, and if they don't pay back money, we won't be able to pay further loan to you or to your fellow group members and things like that. So basically, I thought I will talk about some of these things in a very, very broad way. Risk management itself is a very big topic, and I will say that risk and risk management. If you ask the question, is it a science? Yes. Is it an art? Yes. It's a combination of a science and an art. Science in the sense it uses a lot of statistical techniques to measure and monitor and all. Art in the sense that more than anything, your gut feeling as a person with a lot of experience in banking that helps you to, there are people who are working in banks. Knowing a person, they know that he cannot be given a loan, is it not? You need not even look at the financial statements or anything. One look at the person's face or the body language tells you that you will not give a loan to this guy. And I am sure that all of you must have done that. But so that's why I say that it's an art, but at the same time there are scientific methods. So it's a combination of a science and an art. And risk management is something like I told in the beginning, to optimize the risk, to ensure that your returns do not come down. At the same time, the risk does not go beyond a particular point and affect the institution. So that's all what I thought I will talk in the opening session. So thank you very much, Gigi and team, for giving me this opportunity. And I am quite sure that these three panels which are there today, with all the experience of people I have seen the list of people who are talking in the panel, and I am sure that it's a combination of so many years of experience. Each of them having about some 30 years of experience. So you are listening to maybe 300 years of experience today. So what more do you require? And that is what helps these type of conclaves. And I'm sure that this will be a great success. So keep on educating people, because as you are a very, very highly rated self-regulatory organization, and I'm sure that Sa-Dhan is doing a lot of work in this area. As from ISAF Small Finance Bank, we have a much closer connection, because our MD is your big boss. So naturally, we are very keen to be associated with Sa-Dhan. I'm sure that this will be a great success. So thank you, thanks a lot to all of you.
Thank you, sir, for your valuable insight and providing a base for our discussion today. Now I will request Gigi sir to present a token of appreciation to Ravi sir.
I think very typical of Onam season.
Our next panel discussion is on promoting risk management culture in regulated entities, the role of the different stakeholders, and the best practices adopted by the entities. In this panel, we have Mr. A.M. Karthik, Senior Vice President and Co-Group Head, Finance Sector Ratings from ICRA, Satyananda Prabhu, Chief Audit Officer from Ujjivan Small Finance Bank, Sunil John, Senior Vice President and Head Credit Risk from Federal Bank, Kumuma Sharmila, Chief Audit Officer from Avanti Finance. Udish Ullas, Chief Operating Officers from Muthoot Microfinance. Mr. Ramanathan A., former CGM of NABARD and currently serving in different various board of microfinance. Now I will request all the panelists to come on the stage.
Good morning, everyone. Hope I'm audible. Yeah. Okay. We have an extremely pertinent and a seasonal topic at hand. And we have an extremely diverse panel also. In fact, you cannot have asked for more. You have everybody in the walk of the microfinance sector on the stage now. You have somebody from the MFI, NBFC, small finance bank, and a financial institution who has lent to microfinance institutions and also handled microfinance, from an SAG point of view. The previous address by Mr. Ravi Mohan was quite exhaustive. I mean, he's covered every aspect of risk management. And he brought about one important aspect of, how critical credit risk has become of late. Microfinance, when it started, was largely an operating risk-driven kind of a business model. The RBI regulations of 2022 has in fact broadened the borrower base and has brought in credit risk as also a key factor. Right? So credit risk becomes very important at this point in time because that's what goes into from an underwriting point of view and onboarding the customer point of view. Well, operational risk will remain. We have another panel subsequent to this which will cover operational risk in detail. We'll try to stick to the credit risk part to start with. Let me start with you, sir. In fact, how do you see the key risk strategies emerging in view of what you see in the business environment from a microfinance point of view, from an MFI point of view? Let us hear from you.
Thank you.
Yes.
Yeah. Thank you, Mr. Karthik, for asking this question. Good morning, everyone. Before I answer your question, I would like to place my appreciation and thanks to Sa-Dhan for organizing such a wonderful conclave, very timely one. I think the entire microfinance industry is facing a headwind, and it's absolutely the right time. We all should come together and discuss about the right risk management policies, the best practices in the various institutions. Talking about the credit risk part of microfinance business, as you rightly said, when we started microfinance, it's more about lending to a group, and within the peer pressure, the money will come back. So that is what the typical microfinance business maybe 10 years back. But the current environment, there's a very dynamic changes are happening within the regulatory ambit as well as the external factors like the political risk and the climate risk, which is impacting the business. So for us, I think I can talk about the perspective of Muthoot. So we were for a century, more than a century, we are doing gold loan business. So the DNA of the organization itself is very, the risk appetite is not too much. So they are into gold loan, and the gold loan is the most secured business what we can do. So when it comes to the microfinance, it's the complete opposite side of that business. Here it's completely unsecured and the documentation side is very minimal. Assessing the income of the customer is close to impossible. So when it comes to that business, the advice and guidance we got it from the promoters as well as the board is to that you have to I'm just taking the word service tool, you have to optimize the risk as much as possible. So what we did from our end, when we started, we had appointed a credit officer, which was not so common in microfinance institutions. So we had a separate credit vertical itself. So he is responsible for doing the underwriting of the customer, and he reports to a separate vertical. He is not into incentive plans, rather he works on a bonus plan on an annual basis. So which gives an unbiased opinion on the customer, and we can question him in case of any kind of a mis-selling or any wrong customer coming into the portfolio. The other things which is we learned over a period of his time is that the climate risk, I think sir has also talked about that. The climate risk, and we are one of the main players which is got impacted due to the 2018 Kerala flood. When it happens, almost 50% of the portfolio of Muthoot was in Kerala, and out of which almost 65% is got severely impacted, because that point in time customers' livelihood has got damaged and we could not go and ask for collection for months. So that was a learning for us. So we worked with insurance companies, and now if you see, we are offering a NatCat insurance to all of our customers, which is really helping us. In last quarter, I think December, there was a flood happened in Tamil Nadu, and almost 25 to 30,000 customers got impacted. And I am very proud that we got all the claims settled through this insurance policy, and we didn't have any impact on that event. And apart from that, also in the microfinance, the other major issue is the medical emergencies which coming in customers' house, maybe for the customer itself or for the family members. In case of any medical emergency, it will have an impact on collections. So again, we worked with insurance companies. Right now, we are offering them a HospiCash product as well as a e-clinics which customer can walk in any of our branches. Right now, we have around 550 branches. We are offering this. They can come and do a virtual doctor consultation. So that is again helping the customers to address the early detection of any medical problem they are facing in the organization. Then apart from, when you talk particularly on credit risk, right now technology has enhanced too much. So we are using data to its a maximum level. We have developed a credit scorecard along with Equifax, which is a credit bureau. So we have looked at a data of around 6 crore data, which is internally within our customer base, and similar profile within the bureau as well, and see how they are performing with the competitors. And we have profiled the customer based on 4 risk categories: very low risk customer, medium and high risk. And we won't give loans to high risk customer. Medium risk customer, we are limited the ticket size, and we are now targeting more towards the low and very low risk customer. This is basically gives the credit officer is also additional data point to say that, okay, which customer I need to target more, how much we can let low and very low risk, we can leverage more on ticket size, but on the medium risk we can reduce the ticket and then optimize the risk. And apart from that also, on the documentation side, we use the various fintech services like verifying the customer's voter ID using a fintech service, integrating with banks for doing a bank credit directly using H2H, the host-to-host services. These all will help us to minimize the risk and depend more on technology rather than manpower. I think I should stop here. Thank you.
It's quite a detailed answer. I think you covered almost all aspects of risk. But let me further this to. Hello. Yeah. Let me further this point with someone who has transitioned from a microfinance to a SFB. Right. So, Mr. Satyanand, I'm just wanting to understand what additional structures, apart from what we have heard so far, has been put in by you in terms of risk management and control.
Yeah, thank you, Karthik. So I think our friend from Muthoot clearly mentioned what all they have been using now. Like traditionally, yes, credit risk, which was a very vital risk when it comes to lending. But today what is happening with the credit risk has not remained as a silo as a credit risk. It has a lot of influence coming from operational risk, that too especially technology, fraud risk kind of things. On the one side, we are trying to use the data. Today in a digital economy, digital era, there is a lot of data available with regard to the customer, with regard to our lending patterns earlier. and data is publicly available also. What we are doing to a large extent, trying to use this data, one is to do the assessment of the customer. Maybe from here we would like to advance also. The thought process is to use maybe his footprint in the what is that you call his public domain, whatever footprint available completely. So using that also, understanding the behavior of the client, his history of transactions, these kind of things, we must be able to take a better decision in customer selection. Then again, as a risk management, using this data, we must be able to predict the default rate or who will default, what kind of customers will default. That knowledge also we want to use in, one is in the risk management, in monitoring and collection, other part is in the selection also. Added to that, technology, since it has given a lot of help to us in assessing and managing the risk, it has added its own dimension of risk. As Raymond sir mentioned earlier, risk of technology, and from that related reputational and regulatory risk. We see it as more complex than the credit risk per se. So looking at now, we can't say that we will address credit risk independently. I think it is more of a combination of various risks now. The borderlines are hardly there anything. So I think using the technology, when it comes to technology also, there is a saying, the strength of the chain in its weakest link. So then it comes to, again, what Ravi sir mentioned, training our employees, training the customers, or creating awareness among the customers on their indebtedness, their financial discipline. These are all we are trying to take into account. We are conducting some programs for customers called Financial Inclusion Program, through which we educate them also. So it has to be a combination of technology, training, governance, and credit risk. Together we feel that is how we should graduate to address the risk management.
Sure. So you touched upon the financial inclusion point. So just trying to understand, what we are currently seeing in the microfinance space. Do you think it is a move towards financial inclusion after the deregulation of prices, etc., where one is able to get into a segment which one was not possibly targeting in the past? And whatever we see now are the initial teething problems, and the new guardrails will essentially elevate some of these risks going forward. What is your view? That's a very seasonal question.
Yeah, I think definitely I agree with you. Maybe it is for a short term, because we have seen a lot of these kind of things coming in the field. But then how do we address it? How do we respond to this becomes very, very critical probably. Because again, as I mentioned, creating the awareness among the public, among our customers. Today what's happening, one is regulated entities like us into the microfinance business. On the other side, there are a large number of small unregulated entities who may not have the kind of ethical or kind of customer-centric approach what banks and NBFCs take. That is one of the major challenges today. In fact, yesterday I was visiting some of our branches. Our salespeople primarily were mentioning to me about this issue now, because this will not get covered in your any of the bureau data, or you'll not come to know of that. It is where I think what we have started as an organization to create awareness among our borrowers on financial discipline and borrowing wherever it is available. Finally, why should they borrow from those people? If you are able to create awareness and give them good service, I think we'll be able to retain the customers, so that our recovery and all will go up. So how do we respond to this crisis? How effectively we train or create awareness probably matters more than anything else in this area.
So, well said. In fact, the emergence of smaller players, the unregulated entities and smaller groups who do this internal credit kind of a proposition is something that is also being heard across sectors. But let us move on, maybe from Mr. Sunil, in terms of, because you deal with a lot of the business correspondents and partners for your microfinance business. So how do you see this, and what kind of risks that you attribute for such an arrangement, and what are the key monitorables thereon?
Yeah, good morning all. Thank you, Karthik, for the question. But at the outset, I would like to make two statements. One is, Ravi sir made a splendid overview of the risk functions, and so whatever we are going to say is not going to be any more effective. Second thing, as far as microfinance is concerned, I'm basically from a bank, so I feel like a rabbit sitting among the tigers of microfinance. So anyway, I will coming to this question. We also do certain bits of microfinance. Yes, we made the entry maybe 1 or 2 years back. Our penetration to this has been through tie-ups through BCs. Basically, if we invoke our father of the nation, India lives in the villages, and for scheduled commercial banks, we have a salary structure that is agreed between this management as well as unions. So with that structure, it may be tough for the banks to go into deep interior parts of the country and make business. For microfinance business, basically the target segment is those who are economically vulnerable, especially and those women. For that reason, maybe because of the cost impact reason and our structure, we need to have the association of some partners. That is wherein the BCs comes in. So we consider that BCs are working as extended arms for the bank, and they are helping us to reach to the interior parts of the country and extend our presence as well. So this one, in terms of return as well, we are getting a reasonable return from this microfinance institution. At the same time, these arrangements carry a lot of risk as well. First, the BCs, they are doing, maybe they may be experts in sourcing businesses, but they may not have that much risk awareness as equivalent to that of a bank may not be there. So we have to make them align with the risk culture of the bank. That is one of the challenges that we are facing. Second thing, the attrition rate Ravi sir mentioned, and we also know that the attrition rate in BCs or MFIs is on a higher side. For that reason, we also see that frauds committed by certain BCs are also, BCs may not be BCs, but the employees of the BCs are also on a higher side. So there is lack of risk culture in the BCs. Therein comes our role. We may have to have frequent interaction with these BCs. Then we may have to educate them how to align with our risk culture, what is our expectation and all. So that's a challenge. But overall, we are getting the support of BCs. We have been going for more and more BC arrangement. Then the integration aspects also comes in play. We have to ensure that, mainly because of the, from operational risk perspective, the employees of the BCs might be collecting the amount from the field, amount from the borrowers. We have to ensure that the amount collected from the borrowers are coming to the account of the respective account of the borrower itself in a timely manner. So otherwise, there can be chances of higher levels of frauds impacting our reputation risk as well. Another challenge that we are seeing is, yes, for the end borrower, the face of lending is the BC. They may not be knowing who is behind, who is exactly lending this one. This comes as a challenge for us. So if for any reason, if the BC winds up, that becomes a challenge for us. So we need to be highly selective on the BCs. Those BCs who have established, who have a presence in more than one state, who have a good credit track record, and also those who are having reasonably good pockets, so that when the business enlarges, they should be in a position to put into infrastructure as well as more resources. So these are certain criteria we look into this BCs. But overall, our experience with BCs have been good. Thank you.
Sure, sir. Sure, thank you, sir. I mean, let's extend this a bit further. Ma'am, we have looked into key factors of risk. Now let's try and understand maybe what are the good systems, processes that you think can further improve from where we are now. Credit scoring and borrower scoring is something that has come to the fore of late, and that has become a key factor for incremental credit. So what are the key things that you feel should be included in this kind of practices and scoring, which should be which are good in nature from your point of view?
Thank you, Karthik. When it comes to scoring, the scoring is more in terms of a perspective of the person who is scoring it, right? But at the same time, because like what Mr. Sunil said, the BC culture is improved, it's increasing, and overall, we have to bring in a culture where usually the policies, processes, or any of the master directions that are coming up are being more understood and processed at a senior level, middle management level, and maximum at a branch manager level. But what happened to what is it with the guy who is executing these processes at the field? How much is he aware of what are the processes, policy, and why are they being brought into? It's very important to know why are we bringing up the process and what is the impact if we don't follow the process. And it's very important for the guy at the field to know this more, because it is he who is communicating to the borrower or the customer, the potential borrower, and it is he who is the face of the organization for the borrower, and what he tells becomes that is it. So it is important that that person knows. But here what I feel most of the time is like we restrict the communication and the messaging to the branch manager level, and the branch manager further goes down, and I'm just using the word branch manager just for the sake of convenience, and the rest of it, how this communication is going, how is it getting monitored, that is one thing. And second thing about the attrition that we were talking about, when we have so much of attrition, many of the organizations have the culture of saying, okay, when the employee joins, we give him a training and on the initial onboarding and we'll tell him about all the process policy, and that's it. And he's supposed to understand it, and with the changing environment, which we don't know tomorrow which circular will come up, what does it say and how things will change, and we expect him to be very vigilant about this, which is practically not possible. So an ongoing training with to these agents or the sales officers, and then it is and also telling them it's very important that they pass on the right communication to the borrower and make the borrower more understand the financial discipline in a better way, because from there everything, it is like not the top down approach, in my opinion, it's the bottom up approach. I think that becomes very important.
Sure, ma'am. I mean, over the period, have you seen the scoring evolving? I mean, we do understand that we looked at scoring from a seasoning point of view, from a location point of view. I think these two are the key factors from a microfinance perspective. But you touched upon the leverage aspect and the financial discipline aspect. How do you measure financial discipline? I mean, is there any measurable that you think?
See, I don't want to bring up the financial discipline aspect into a scoring of 1 or 2 or a measurement of, because it's all depends from person to person and how you perceive it. So the scoring methodology, definitely it is evolving around, and that is how we have brought in we bring up all this pre-approved loans and all, which gives us some kind of comfort based on the intention of the borrower, and also the financial discipline of the borrower and the history that talks about how the borrower is. But at the same time, the new to credit borrowers are a little challenge for us, because definitely there are many unexplored areas of new to credit which we are little hesitant in going towards that because we are comfortable in the already tested and tested environment. So maybe that is something that we'll have to look at also.
Mr. Ramanathan, I think this you've heard all the points of the existing players. NABARD being the nodal agency or the champion for the SHG model, and SHG is a very big business model. I mean, I'm not sure how many people appreciate it because it's close to about 2 lakh crore in terms of AUM and touching close to about 16 crore households is what I last read, which is from an AUM point of view half of what we see in the other NBFC, SFB banks put together, but it's covering twice the households. You have about 8 crores here and about 16 crores there. So what are the key learnings? And because SHG is again a very old model. I mean, it's like you can say it is a parent model for all the things that we see now. So what are the learnings that you feel you can you can pass on to the team here?
I think I'll be not talking about that. I'm sorry about that because I retired from about 16 years ago. So the latest development, whatever is happening, like Gigi, who retired about 2-3 years ago, about self-help group. To me personally, I think I will share some of the experiences of my 16 years being on the board of NBFC, MFIs, in and out. Like immediately after retirement, I joined Samasta board 2009 when it was less than 40 crores, and when I came out this March, it is 13,000 crores. So I've seen that how they struggled to getting the capital, the risk management, other things. Similar with Asirvad Microfinance, which I came out a year ago after completing my tenure, and good number of smaller NBFC MFIs. Whether I'm on the board or I'm not on the board, I know them personally. Like here also, I have seen good number of my friends, including Ganesh. So I will share some of the experiences very briefly. To me, if you look at all the MFIs are coming under either middle layer or base layer. Middle layer, unfortunately, it is from 1,000 crores to 20,000 crores. So all coming under middle layer. What I will do is I will divide the MFI into less than 1,000 crores and 1,000 to 5,000 crores, above 5,000 crores. If you look at the large MFIs, they have an excellent risk mitigation system. They have CRO, they have chief audit officer, they have a board approved policy. They keep in touch with the board members very frequently, conduct frequent board meetings. Whenever there's some changes in the system and process and product, they immediately contact the board members. I have experience of that. The other extreme is smaller NBFC MFI, they don't have the luxury. And if you look at the mid-size MFI, above 5, I'm talking about top 15 MFIs, they have the luxury of investment in technology, they have luxury of investment in various things. I don't want to repeat that. And even new product development, product diversification. Look at the smaller NBFC MFIs, they don't have the luxury. I'll start with capital. That is, to me, it is one of the major risks for the smaller NBFC MFIs. I have seen NBFC MFIs, at least 7, 8, 9, 10 of them, being at the same level for the past 7, 8, 9 years, not in a position to grow because they don't get capital. Whereas the top 15 MFIs getting capital is never an issue. So I have 10 crores, I start a company, NBFC MFI, or I was a trust and society converted into NBFC MFI. What next? When you remain, and you know what's I take just 2-3 minutes on this point. What is the margin they get? The large MFI, the top 15, again I repeat, with A rating or A plus, A1 or, they get borrowings from our friends, including at 9.5 to 10.5%. And their lending rate is around 24, just I'm saying around 24, some are 21, 22 also, but average. What's the clear margin? It is 14%. And they have, because of the technology, investment and the things, they have operation cost less than 6%, around 5% or whatever it is. Look at the smaller NBFC MFI. they get borrowings from the same bank. I will not call it. The State Bank of India gives to the top MFI at 9.5, for the smaller MFI at different rate. So their average cost of borrowing is 15%. And their operation cost is not less than 8-9%. Because they don't have the luxury of technology investment, etc., etc. Then they have a credit cost of 3%. Am I borrow money from, they borrow mostly from other NBFCs like Mars and others. Am I borrow money and lend and incur loss at 20, even if I lend at 26, 28%? I work hard for the whole year, and what income I get in the end? A few lakhs net profit. That too, not interest income from product cross-selling or your insurance products, whatever. So that is one thing, interest and capital. And they don't have a good governance system also. That is another risk, great risk. Because I myself, I know very clearly, because like I was telling that it's about 102 NBFC MFIs, the latest. Yeah, I joined the latest one last month, which started its operation in August. LOLC India Finance Bombay. That's the last NBFC MFI in the list. So it's about 102, starting from that and last startup NBFC MFI. See, if you look at the LOLC MFI, they have no problem on capital because it is from LOLC group, which is a very large group in Sri Lanka. So that type of NBFC, MFIs, startup or whatever it is, they grow. But what about the professional? So many good MFIs are there. I suggested what I have been suggesting for the past 10 years. I left it now for the past 2-3 years. I don't even talk about that. I said, see, I know at least 6-7 smaller NBFC MFIs are there in Tamil Nadu, not less than West Bengal. You have how many? 5-6 or more smaller NBFC MFIs. So I have been telling. Now I stopped telling, as I told you. Why don't you 3 or 4 smaller NBFC MFIs come together, merge, and become 100 crores capital MFI, grow? It is good for all. I tried, even connected NBFC with NBFC, MFI with MFI, even it went to the level of, I know our friends are here, they have the experience because I know at least 2-3 of them. We tried, but it's a failure. Ultimately, it is like after the election, the selection or election of CM takes about 10 days, who should become the CM. So like that, if 3-4 MFI merge, who will be the MD? Who will do what? What will be my role? But I feel even today, though I stopped talking about that for the past 3-4 years, but I feel I don't know whether Sa-Dhan or MPIN can initiate the process of making this type of NBFC to work together. Otherwise, what do they do? For the past 4-5 years, they don't make money at all. They don't get capital. The borrowing cost is so high. The governance is very weak. Very weak, what I mean to say is, they can't invest in technology. They don't have risk management, CRO type of thing. So board meeting is only 4 times a year, the required mandatory, unlike the other companies where it is about 10 meetings a year or more than that. 4 or 5 Zoom meeting, 4 or 5 physical meeting. So this is one thing. This is, I feel, a smaller MFI, this is a risk. Then comes artisan. Gigi was telling 100%, and normally it is 60%. But I know some companies, I'll just give 2-3 examples, experiences, sharing. There is one Hindustan Microfinance. Anybody from there? Nobody. It is in Bombay. What they did was, about a year ago, they selected 15 officers from the field level to the middle level. They have confidence that these guys will be in a position to groom themselves into the higher level, and they will take the NBFC MFI forward in the next 3, 4, 5 years. So what they are doing is, these 15 fellows, 1 year continuous leadership development program with the help of a professional leadership institute. It's on weekends, off-site, on-site, all those things. The inaugural program, I was there. It was really a very good initiative. And look at that, in that particular company, the attrition is very less. Another company is Swasti Microfinance, where I am on the board. Every year for the past 3 years, they select good performers from the field level, particularly, and the branch manager level, and take them to like Bali and some other countries, neighboring countries. And they said that the guys were excited because for them that is the first experience of being the flight, and that too from one country to another country. There also comparatively artisan is a bit less. And we have Natarajan, South India Invest. You are in the panel of bus, so you will talk about it there. So there also artisan is very less. You hear from me only instead of my telling. So these are the type of. I have some more experience also, but I don't think the time will permit conducting some type of special train. See, large companies, they have a lot of good investment in training and development. For mid-size, less than 5,000 crores and less than 500 crores, they should have a regular training program on this type of leadership development or ODI, we know, Organizational Development Intervention Program, not very intensive. I myself conducted one, I didn't call it as ODI because ODI needs real experts. So I thought Organizational Development Initiative. I conducted one program for middle level and field level officers, and believe me, the next 3 years things were okay in that organization. We have that type of role space, what is my role, and within what space I have, how I can operate, what is the role efficacy, and what I can do, all those things. But after 3 years, it started coming down because like artisan or whatever you call it, the new guys joining, new branches opening, new area, that's one. Smaller MFI is another issue, just with that I'll finish. Large MFIs, they work in more than 10-15 states. So they have the luxury of restricting their exposure to any state not more than 10%. Many they have even district wise. This district, within the state also district wise exposure limit and all is there. But can smaller MFI have the luxury? They themselves work in a particular state, only one state and a few districts. So maximum what they can do is in one district it will not be more than 15%. More than that. So that type of even geographical concentration also. So if something happens like Assam when something happened about 2-3 years ago, the smaller MFI working in Assam, they really struggled very hard. So that way smaller MFI, I think Sa-Dhan and MPIN, they should have some special policy guidance, some handholding. I don't know, they can't help in getting more capital or getting lesser cost of borrowing funds and all. But otherwise, how do they survive? How do they grow? Surviving they are doing. Sustainability is always there. They are sustainable. Reputational risk and all those things are there that I don't want to talk now about product selling and one more small thing. Why MFIs are not creating a brand image or a corporate image? See, when small thing happens in a district, say in Vellore, it is blown up by the media. Fortunately, Sa-Dhan, MP, they take immediate steps, they go to the district, they sit with them and they do a lot of things. Hats off to them, because they really do a good thing. But the other side is, when a bad thing happens, the media jumps on that. When good things happen, NBFC, MFIs, they don't share with the media. They don't really share with the media. See, I remember one of my bosses telling, not only you should do a good thing, but others should know that you are doing a good thing. That's not happening. Now, he said the old concept has gone. What right hand gives, left hand should not know. Those days are gone. Now both the hands should know that good things are happening. So that is not happening. That I don't know how we are going to do, but create some type of engage the borrowers, be with them, engage your field officer, be with them, belongingness, create belongingness, role space, role efficacy, all those things, and create some type of image building, brand building, building correct. IIFL Samastha is a brand. Like the old advertisement, you remember, I don't know. Tata Steel used to advertise heavily on so many things, and in the corner, we also make steel. So, do that. do so many things, go to the field, talk to them, be with them, create image, talk to the media, share the good thing, prepare case studies, share with other MBFs, MFIs. See, why don't you learn from each other's experience? That also we don't do it. Learning from and with each other, that is not happening in the MBFs, MFI. See, you mask the name of the MFI, but at least the good practices, good success stories. Why don't you masking the name of the MFI, making it as case study, and making it known to others so that they learn from each other? That's also not happening. So I feel the reputation building, media, whatever, how you do it is like you know better than me. That is not happening. That is
I think you've touched upon many measurables. I think one is attrition, the other is visibility, controls, etc., etc. So a lot of these things will go a big way in terms of mitigating risk. But in terms of the other factors, Mr. Ulas, I mean, how do we measure? Are you looking at other measurable factors which can, be important? Let's say loan quality is maybe one number. But is loan quality alone a measurable number? Attrition is something that we can again be a measurable number. But anything else that you think which is measurable in terms of assessing and whether we are going in the right direction from a risk point of view?
No, I believe all performance parameters are measurable in terms of how better your risk management is, be it profitability, be it your credit cost, your attrition. I think all your liquidity per se. So it's all depends on how better you manage your risk in your organization. I would like to add on the attrition, but I think this is one of the buzzword in the industry. Now people are talking about 50, 60, 100% kind of an attrition. I think most of us were doing a lot of things which is very common, like we do a lot of internal promotion, which is the one of the attraction towards the microfinance industry. People comes, join as a field officer, promoted as branch manager, and then upwards. That was this off-site trips we used to do. Means most of the MFIs used to do, but still the attrition is on a rise. So what and where we are going wrong? I think one thing we all should look at is the load management. How much load a guy can take. I think that is something very, very critical, because gone are the days we go to a center meeting, we'll get collection in 10-15 minutes and come back. So in the past we used to say that, okay, the first half you do the collection, the second half you do the business, and by 5:36 you go home. So now the collection itself is taking 4 o'clock, 5 o'clock, then additional target is coming to him, so you need to do the business as well. So he's a poor fellow, is coming after his graduation or a 10+2, and he has seen the industry or the field which is now somewhat heated up. I should not say that there is no 99.9% collection, which were the case before the demonetization. So now if you get 96%, 97%, you are doing a pretty good job. I'm talking about the on-time collection. So we have to work with him and understand whether his load management is scientifically measured, whether he is able to manage 5 centers, 6 centers, 7 centers in a day, and what is the productivity expectation, a realistic productivity expectation we can put in place, whether it is 20 loans, 30 loans, 40 loans. It depends upon the growth appetite of the organization as well. I think if you do this and we work with them, and what we are seeing in our organization also, we are seeing is that the first 3 months, the infant attrition is very high. The moment he complete that infancy stage, like if he complete 3 to 4 months in the system, then he'll stick on. Then he understands the culture of the organization. He understands the way the supervisor is managing him, the support systems and everything. So I think that is somewhere we all need to work on, because the first 3 to 4 months we have to unhold him. Plus we should really understand at the head office level what is the load is put on to him. We can use technology. There are a lot of geo tracking mechanisms is there. We can see how much kilometers traveling in a day. We can see if you can tag your problematic centers and see whether we are assigning the new employees to the problematic centers or not. So there are various measures I think if we can take, I think that can help controlling attrition and a greater extent, this is from our experience. We were also facing a lot of attrition, but we are working and putting this as part of our risk management policy and saying that, okay, these are some measures we should take to control the attrition. I think, I hope I answered your question. Thank you.
Sure, I think you've covered on the operating risk part to a good extent, which is again linked to the field and attrition. Mr. Satyanand, I mean, anything that you would want to add on the credit risk part? Essentially, from an over-leveraging point of view, are there any new ways to assess over-leveraging or concerns that we currently see in the business?
I think over-leveraging is an issue today. One of the things probably we talked earlier also, the data, use of data. Unlike earlier only bureau we are depending upon. Today it is not so. We are able to use the tools to scan through the statement of accounts of the customer, his spending habits and his pattern of his earlier loans, how repayment came, all that. With the now use of AI and ML especially, earlier credit scoring we used to depend upon scorecards kind of thing, maybe with 3-4 parameters. Today it is not so. There are so many parameters and analytics goes into that, including big data. And AI will be able to do it much better, the credit risk analysis and assessment. And then people are putting on that ML now, by which it will learn on its own and develop. It will be able to give us very accurate on an assessment. Maybe it is on a score of 1 to 10 when you assess customers. And your rating, pricing also linked to that. I think that is happening now more of, which is helping a lot in addressing the credit risk. Because higher risk customers, we are pricing higher so that the risk, whatever default, we are covering in that. That is one part. And 3 lines of defense also is becoming more effective in banks now. Second line and third line playing more active role. Now, second line through various using the algorithms, models and all that, even RBI wants them to do those kind of exercise. So on portfolio level monitoring also is becoming more effective with these kind of things. And as a third line, audit. We also do regular audits wherein we create awareness also. It is not just audit, it is creating the awareness. Finally in microfinance, how effectively you create awareness among your lower level employees and among customers. That on that entire credit risk management depends. Here all the 3 lines are playing very effective role now in banks at least. Probably that is the right approach to address this issue, I believe.
Sure, sir. You touched upon the internal audit part. I think that also has evolved over a period because now the internal audit scope itself seems to have changed. Ma'am, would want to understand from you how are you seeing the scope of internal audit? It's essentially a post-dispersal, post-sanction kind of a exercise. And what are the key takeaways that you see in the post-audit?
As in my opinion, internal audit is not something like what you said. It's like not obviously the post thing because it's now changed during the last few years. Internal audit is more to understand how is the control working, is the control in place, and mostly it is on the preventive controls than detective, because once you do a detective control, it'll only take you to the lessons learned. You know, you will learn a lesson and how you implement the lessons that you have learned to your process or policy perspective. But when new process or policy or a direction is coming from the RBI, it becomes very critical not to wait for the audit periodicity of that particular branch or a particular function, but to do a control testing well before. As soon as a circular is released, or I'm just giving an example of circular, within a month or 2 months, to see how is the understanding of the circular and the implementation of a control. Because now it's more on preventive control and internal audit is moved to an assurance function. more than a function which identifies, observes, and highlights issues. It's more an assurance function. So, as an assurance, it's important that we look at things before damage are done.
Yeah, got it, ma'am. Got it. End use is something that used to be a very key factor of internal audit. How do you see end use now? Because the new regulation for NBFC MFIs essentially excludes the requirement of a productive end use, which was there previously.
Correct.
Now it is even for a consumption loan, a microfinance loan can be, it can be tagged as a microfinance loan. So how are you seeing that on the field?
To be very frank, I think there's something that we'll have to really look at the end use, because the kind of stringent way of looking at the end use which was there 5-10 years isn't now. Because the concept comes up saying, okay, when we gave the loan, we look for the purpose and we look for the probable utilization of the loan. But after handing over the money to the borrower, on what they are using it and how they are using it is not in our control. So this is why on my previous point also I was telling to talk to inform the customers on how they can leverage with the available credit facility by doing it in the right manner, so that they are privy to more and more credit facility, right? So you will have to explain to the customer as to you not utilizing your loan amount as per your commitment would definitely bring in issues in your repayment. And second thing is how a company gauges you on the history of your utilization.
No, the end use becomes important even from a bank point of view when you're sourcing it via the BC, and there is a bit of a question around how do you classify what kind of risk weights apply and so on. So end use becomes more important from a banking point of view, sir. So how you see, Mr. Sunil sir, how you see the end use and how do you monitor end use?
So definitely we have been considering in general that personal loan, it is given for a consumption purpose and we need not go for ascertaining the end use. But those who have heard the last MBC announcement and speech by RBI governor, even he was indicating that the personal loan end use also should be ascertained. So so that shows the importance of ascertaining the end use. As far as microfinance is concerned, so mainly we are not lending for consumption purposes. Our focus is for giving loan for a productive purpose, so that the income generated from that will support the repayment. So consider a loan given for buying a stitching machine or buying a cow. It's being used for some other purpose. Then definitely that borrower may not be in a position to repay that one. He would not be in a position to generate income or repay that loan amount. So it is necessary that it is critical that we ensure the end use. It is going for the purpose for which was lent. Second part is, as well, we have limitations in enforcing. If at all, if the repayment is not happening and it is classified as NPA, there are certain limitations in recovering this small ticket loans. Legally, it may not be possible, and again, this being small ticket loans, while we go for recovery and all, there will be a lot of opposition from this community itself. So, we consider that rather than the classification perspective, it's the end use ascertainment is the critical function of credit deployment. That's what we feel.
Sure, sir. Last question, of course, from a regulatory risk point.
I think I have a little different perspective on this end use. I thought I will share. When it comes to a loan of maybe 50,000, 60,000 or a lakh we are giving to a person who is doing a small business, Easy has a differentiation between what is his business invested in capital or what he is spending for his personal purpose. Now on paper we can say end use is required. Earlier also what was happening was on paper we are bringing something on end use because it was a regulatory requirement for me to make it as a priority sector or those kind of things. Today that is not that. What is required, as we discussed earlier also, my bank team creating awareness on financial management with the people, that what you are borrowing should not add to your indebtedness, instead it should add your productivity. I think that matters more than talking about it is very sacred, I must have end use and I must have a record. I don't think it makes much of a value. That way, what changes you have brought now, I think it's in a very positive and practical aspect.
Sir, maybe the last question on the regulatory risk, sir. I mean, your views, Mr. Ramanathan, on what do you see briefly, sir? What do you think on the regulatory risk on the sector?
Regulatory risk is, I think, like our friend was doing. Sorry. Yeah, regulation is like, again, if you look at the large MFI, the RBI has a very clear policy of on-site and off-site, what you call, inspection. The RBI circulars on risk management particularly, very clear and very candid. What MFIs are generally saying is like a political risk, what we call regulatory risk. See, regulatory risk, you can't call it. Regulation is a must, regulation is required. And RBI, I repeat, RBI regulations, one thing what we see now is the frequent and almost, we say, every other month we get RBI circular, some modification. So that is one thing which is like offsetting some of the smaller NBFC MFI to meet the requirement. But otherwise, I don't think any regulatory risk as far as microfinance sector is concerned. I'm talking about RBI. They also deal with insurance products and all that. Also, I think that they are doing it as a cross-selling of insurance product, the health insurance products and all. So I don't see much of the regulatory risk except the frequent and every almost alternate month coming out with the new circular and this new modification. That is the one thing which may upset the NBFC. Otherwise, I don't see any.
Sure, sir. I think we should conclude. We can take one or two questions from the audience.
Am I audible enough? Yeah. Okay. So thank you, Panak, for the wonderful points that you discussed. So Vish had mentioned one very important thing, that management of the bandwidth of the field officer last mile connect, right? That's where, like, from my experience, I've found it is pretty challenging because, of course, there is one thing like we talking about the risks, how to manage it, etc. But finally, the n-mile person is also required to meet the targets. Unless he performs, he is checked out. A company needs to survive with the performance. So how do we manage these two, particularly in the current challenging situation where meeting the target is important and at the same time the risk management mitigation measures need to be educated, given to them, but they need, if we give them proper training, etc., and ask them to stick on to the process, the question coming back from the field could be, then how will we meet the target? So how do we tackle that?
Thank you, Casey. No, I think it's a very valid question. I think we are all exercising it. That's what I said. Hand-holding is the first thing we should do. For example, as you rightly said, the changing environment. Collection is the most toughest job to do in the field. Most of the time they come back and say, we visited customer, we sat there for hours, but we could not got the collection. What else we should do? We need to achieve our target. So we cannot sit over the full day over there, then we won't achieve our target. So it's an expensive model, but we should do is the bring supporting systems in place. I think what we do in our organization, the responsibility is given up to the 30 DPD. Anything going beyond 30 DPD, we have created a supporting system that we created a telecalling facility centrally. They will follow up with the customer and they will generate promise to pay dates, and once the date is finalized, the field officer need to go and pick up the payment. And anything going beyond the 90 plus, we have created a separate collection vertical where they will do the follow-up. They have feet on street people. Anything going beyond 180, we have a legal team. They will do the sending the demand notices, doing the log adalats, filing few arbitration cases just to create fear among the customers that the customer should also know that there is a legal recourse is also possible in microfinance. It's not that it is not at all possible. Yes, we know this is a very sensitive set of customer. A political risk is associated with. Beyond that, also in certain location, just to create the fear and awareness among the customer, we can do legal recourses. We can take legal recourses. It's very much possible. These are certain hand-holding and support system if we can create and ensure that you are not alone in the field. If you want support, there is support systems are brought in. And even for the achieving target also, by utilizing technology, we can introduce pre-approved loans because the credit underwriting norms can be checked at the back end, at the central level, and the cases can be given to him, and so that he don't need to visit every customer to convert. He know that by the beginning of the month, these are my easy cases, the long hanging fruit. These can be converted easily, and maybe rest of the target he need to work slightly more harder or slightly more need more time to achieve target. So I think these are some measures we can take to ensure that there is a proper hand-holding system is built in.
Question to Mr. Sunil sir. Sir, building a BC portfolio is better or building the own portfolio is better? From your experience, I wanted to listen. Because we have built a BC portfolio and we have seen, we have burnt fingers through BCs. So we have the opinion that building through own portfolio will be better. I wanted your suggestion in this.
For us, creation of quality portfolio is important. We don't mind from which channel it is coming. If we are creating our own through a channel and the quality is not able to maintain, then there is no meaning. At the same time, if BC is able to provide us a quality portfolio with reasonable return, we will be happy with that one. Maybe what we may have to do is we have to continuously monitor whether it is our organic portfolio or through our tie-ups. We have to have focus and on the quality of the portfolio has to be continuously monitored, and we may have to take corrective measures. That is maybe more important. That is what I feel. Maybe we are now living in the era of fintechs. Other platforms, technology platform, BC arrangements, co-lendings and all. So we may have to, there may not be an option, but we may have to coexist either by collaborating with them or competing with them. So maybe collaboration could be maybe one of the best available options in the present circumstances, but with a focus on the quality of the portfolio, whichever be the channel, originating channel.
Yes. In fact, microfinance, we have been seeing the group model, JRG model for the last 25 years happening, and there's not been any change happened in the past 25 years. The model is the same. And now, with the raising or increasing the risk, in the sector, do you think that there is a need to change this model? Have we reached a level where the current model has reached a level where we need to think of a modification?
Sir, I think that's a very valid question. I think part of your risk management, that diversification of product, it's not only diversification of geography. You have to, some point in time, start thinking about diversifying from a group loan and doing an individual loan. Maybe as the regulatory permit 25%, we can do the other business. So look at some portion is moved into a collateral based loan as well. Since you reach that level, then you can, using technology, we can carve out the creamy customers, the good customer base from the higher level, as you know, you already have the data points, the income levels, and the repayment track record for the years. So it's always better to have a product diversification. I think the industry is slowly moving towards that. I think the group loan will remain, but a certain percentage of the portfolio can be moved into a collateral based or a high ticket individual loan kind of a portfolio.
So, just one last question, time permits. Follow up with the earlier question, first question. We have looked at various incentive models for the center manager or the loan officer. In your experience, what is the best mix kind of? Because this, based on various analysis, has a direct correlation with the attrition also. So, what is your opinion on that?
The typical legacy model is having a incentive for both sales as well as whatever business you do, and plus the collection he is bringing. But the changed environment, at least from our organization point of view, moving into a point system that we have to, as I said, we have to measure each of his load, maybe the KPIs, and see what he do better. For that, we need to reward more. If he's doing something wrong or something not up to the mark, maybe a disincentive, or which can also be brought into his annual performance management, the appraisals also. We can correlate it to say that, okay, these KPIs is performing good, this KPIs is performance is weak. So if we can brought in a point system, and each of the point we can kind of tweakle, even if it is on a quarterly basis, if we say that based on organization's requirement, maybe we want to focus on NPA this quarter. I'm telling you an example. We can increase the weightage for those points. If we brought down NPAs, we will give more incentive. For example, if a final quarter, normally everybody will look at more growth, then we can tweakle the point, say that if we achieve target, he will get more points. So if you can bring into a point system, so not only that, there are certain hygiene issues also. For example, if you reach centers on time, or maybe he's complete his collection by afternoon, he will get certain points. Then in our process, we have an end of the day process. If the branch is completing end of the day process every day without delay, then certain points can be given to the branch manager. So I think in the changed environment, what we feel, this is one good model. We are already rolling it out. So maybe it has to evolve over a period of time, and we need to use technology also.
I think we'll conclude with this. Thank you all the panelists for extremely insightful pointers. I think it would be very helpful for everyone going forward, and thank you audience for your questions. I think very good questions also from the audience. Clearly indicates the nature of the people sitting in this room. So very, very skillful and very, very intelligent people. Yeah, thank you. Thanks.
Thank you, Mr. Karthik and other panelists for this insightful discussion. I will request Mr. Ravi Mohan sir to present the token of appreciation to our panelists.
Sorry.
Yeah.
It is joined for a photo. Oh.
happy to be here before you all today to representing Ace Money and also our holding company Radiant Cash Management Services Private Limited. So I would just like to start with a small intro about Ace Money, what do we do and where we are. So we are a small startup. We started based out of Kochi. We started in 2020. We are basically into business correspondent businesses, BC businesses, identifying business correspondent points in the core rural areas of the country and providing the banking services to the rural people through the business correspondence. So our journey started in 2020, which was during the peak pandemic time. We actually found out the need for physical cash with the customers. Like at that time during the pandemic, as we all were locked down at home, people couldn't go out to bank or to the ATM counters to get the cash for their needs. And we developed an application, Ace Money, which enabled the people to order for cash. Like similarly, what you do with Swiggy and Zomato, the people can download the application, book for cash delivery, and our executives deliver the physical cash at the doorstep of the customers. That is how the journey started in 2020. Later, we expanded our products to other banking services as well, based on the feedbacks and requirements from the customers in the application, along with ATM withdrawals. We also added money transfer services and all other banking services provided at the nearest doorstep at the doorstep of the customer or at the nearest BC point of the customers. So we started initially with the municipalities and corporations where we hired our own staff to go to the doorstep of the customers. And later, after the pandemic, we realized that the potential of this application or this service is not in the urban sector. Even though we started with the corporations and municipalities, we understood that we are getting more orders from the rural part of the country than the urban part for cash delivery and other banking services, because in rural part we know if they want to go to a bank, they might have to travel like 5 to 10 kilometers to reach the nearest bank. It is a half-day job for them to go to the bank and do a transaction there in rural part. So when we came to know that this is more applicable in the rural part, again there was a problem for us that it was not practicable. It was not easy for us to hire our own staff everywhere in the rural areas, because we were a small startup and we didn't have that much capital. So we thought like we started thinking like having business correspondents at every core rural areas, so that this business correspondents will help us with delivering these services to the people in the rural areas. And that is how we started our journey in the BC business. And in 2023 December, we joined hands with Radiant Cash Management Services, head office at Chennai, which is a cash management service company with a legacy of more than 19 years now. So now today, I'm here before you to present a very simple solution for one of the problem which you might be facing in your NBFC and microfinance companies. So this problem is, can you move to the slide? Yeah. So as you all were aware, RBI actually came out with a circulation stating that the NBFCs and microfinance companies cannot lend more than 20,000 rupees in cash for gold loans. So the circular came out in May 2024, May 8, 2024, which more or less affected your business, because the microfinance companies and NBFCs are more located in the rural area, where your customers are more or less like very normal people, very public people, the people who handles cash more than digital money. So when a customer is coming to you for a gold loan, so maybe it is for 40,000 rupees and they are expecting 40,000 as cash from you, but you are not allowed to give them 40,000. Maximum 20,000 only you can give them as cash, and rest 20,000 you have to transfer to the account of the customers. So nowadays, if you see, the technology has grown in such a way that more than it is user convenience, now we say user experience, right? It is from a convenience factor, it has gone to the experience factor level. So if even though the public may not be knowing, we will be having many regulatory issues or regulatory compliances, nobody is interested in that. But at the end of the day, what they want is, we came for cash, we want cash. But you are unable to do that. So I'm giving you a very simple solution which Ace Money can give for that to you. Next slide, please. Yeah, so this is the problem which I'm highlighting here, the liquid cash preference of your customers, because 80 to 90% of our households or the rural population who are using your services. And there are other available market players also, the public and private sector banks, as well as there are many unorganized financial lenders who will not come under all these RBI regulations, and they will give money to them. So when cash is given or when their convenience is met, it is a tendency for people to go to the more convenient source to get the money. And organization system requirement, maybe like you will, if you are going to a system or if how to manage cash, you may be needing more operational cost as compared to doing the digital transactions. So what we offer here is, we do have services called micro ATMs and AEPS. Everybody will be aware of this very two services. So micro ATMs, as I told you, we started with delivering money at the doorstep of the customers. How do we do that? We had micro ATM machines with us, which is a very much calculator size small devices, in which will work really as a big ATM machine, but the only difference is physical money will not be dispatched from the machines. We have to carry the physical money with us. So what we offer here is, at your branches, you can even take the services, use the micro ATMs and AEPS. For example, if I'm saying 40,000 is the loan money which you have to give to your customers, 20,000 you are already giving as cash, and you have the balance 20,000 rupees. Without compromising the compliance, you can transfer that 20,000 into the bank account of the customer. Later, instead of asking the customer to go to the bank or to the ATM counter to withdraw the money, then and there itself you can ask them to swipe their card in the micro ATM machine which is there, and you can hand over the rest of the money as a physical cash to them. So this in turn will make you also act as a ATM counter, if I could say. So that is micro ATM machine. Also we have Aadhaar enabled payment system machine. The customers who doesn't have a bank debit card, you can just withdraw the money using the fingerprint or the Aadhaar number which is connected to, if they have the Aadhaar card which is connected to their bank account, they can use the Aadhaar enabled payment system to withdraw the money. So here you will be you will be eligible for giving the liquid cash to the customer, at the same time generating a small revenue from this business as well. Whenever you are doing a micro ATM or AEPS transaction, not only you are giving physical money to the customer or making the customer satisfied, but also you will get a small revenue from each transactions which you are doing. Also, we have payout API services, like immediately if you want to transfer money to the customers, you can use the payout API, which will be like the similar one which you are using like NEFT or IMPS you can prefer, where the charges will be much lesser than the banks which are offering you. So this is small explanations about what I have already told you, the payouts. The payout will help in the distribution of funds from account of the customer or the vendor to the accounts. So payout API will facilitate NEFT, IMPS and RTGS services. This can be done in three ways. One is API integration. We can integrate your software with our software in a way that in your software itself you will be able to do this. SSO login, we can give you a separate login for doing the transfers, and independent system if you want to do the service in Ace Money software itself. We will give you a separate software in your bank's name. It will be white labeled and you can use the system for the payout services. And this is the micro ATM and AEPS machines which I have mentioned. In the micro ATM machine, you will have a small slot at the side of the machine where you can make your customer swipe their card and the transaction will be done. So in this case, the settlement of the transaction will be coming into your bank account the next day. Like the bank account of the customer will be debited and this amount will get settled to your bank account the next day. So here again, like you can disperse your physical cash there and without going to the bank accounts, it is getting deposited to your actual bank account as digital cash. So this is features of micro ATM. The user flow is very simple. Initiate the cash withdrawal and customer will insert the card and enter the PIN for verification and then it is done. So the cash is getting debited from their account and credited to your account. You can hand over the physical cash to them. AEPS is again, if there is no bank debit card or credit card, they can just use the biometric based withdrawals where either they can use their fingerprints or they can even use their Aadhaar cards to do the withdrawals. And DMT services, direct money transfer service, like as I have told you, the IMPS and the NEFT can be done at a much lower rate in this. So I think this is the end of the slide for Radiant Ace Money, and here I would like to tell you another service which actually when we both like Radiant and Ace Money join hands together, we are actually giving you a more good service which is instant cash services, which Charles sir will be speaking of after this. So the Insta Cash services, like if you look into the website of Radiant, you will be able to see what do we actually provide, and what they have given there is peace of mind. Always handling the cash and cash related things is always a headache for everybody, right? So Radiant is coming up with a solution where they will manage your cash, they will pick up your cash, deposit it in your bank account even if it is in a non-banking hours. It can be second Saturdays or fourth Saturdays or even Sundays, and you will get an instant credit in your bank account whenever the executive is picking up the cash from your system. So the device cost which I have mentioned here, the AEPS as well as micro ATM devices, either it can be a CapEx model or an OpEx model. CapEx model in the sense the device cost which you have to give initially, and then the transactional revenue whichever is coming can be taken by your company itself, or it is vice versa, like we will be giving you the devices in free, but in turn till the device cost is recovered, the transactional commissions which will be coming will be collected by Ace Money. So it is, when I say device cost, it is similar to the size of the device. It is a very, very less cost, okay, very small cost. So it is very much affordable for everybody. So that is it. This is a small part of our service which we do. So I hope this will help you to solve some of your problems and retain your customers. Thank you.
Thank you, Nimisha. Now we will go to our next session, which is on managing operational risk in regulated entities, strategies, systems, and controls. The moderator for the session is Mr. Jagadish Babu, CEO of Pragati FinServe. As speakers, we have Mr. Wilson, Chief Risk Officer of ISAB Small Finance Bank, Mr. Anu, Chief Risk Officer of Annapurna Microfinance, Mr. Natarajan, Chairman and MD of South India Finvest, Mr. Chandra Mauleshwaran, Head of Audit, Bellster Microfinance, Mr. Charles Francis, Chief Business Officer of Radiant. Now I will request all the panelists to please come on the stage. This till 1:30.
have the mics. Karthik, mics.
Good afternoon, everyone. We have strict instructions from organizers that we should not take the operational risk crossing beyond lunchtime 1:30. So we will try to keep the panel as efficient as possible. So before I introduce the panelists, just want to touch upon the background of the topic that the operational risk that we're talking about. I think it's pertinent to first define what is operational risk. I think if I go back to the first set of the RBI released on operational risk management, they said operational risk management is everything excluding credit risk, market risk, and liquidity risk. Right? Which, in essence, it covers literally every aspect of working of every financial service organization. So that's even way back as 1990, it was seen operational risk was seen as very, very wide in scope, touching upon every function of the organization. In the last 2 decades, we have seen that there's been significant changes in the way financial services have been run, serious globalization of financial services, adoption of technology, especially automated technology. All of these changes, including outsourcing of services to a large extent, dependency on third parties to deliver the financial services, digitalization of customer affairs services, all of these changes have made operational risk far more complex, far more detailed oriented, and far more critical to the working of the organization. So with that as a background, I will just introduce the panel we have with us today. My name is Jagdish. I am MD and CEO of Conclave Finserv, based out of Hyderabad. We are part of Northern Arc Capital Group, with a subsidiary which runs rural finance for Northern Arc. With us we have Mr. Wilson. Mr. Wilson is the head of risk for ESOP Small Finance Bank. Mr. Wilson has previously been with the head of risk for Federal Bank for more than 3 decades. He's a master's in economics, and he's also a member of the Institute of Bankers. We have with us Mr. Chandramollishwaran. Chandramollishwaran is the Chief Audit Officer of Belstar. Belstar, we know, has made tremendous progress in the last few years. 8,000 crore company, more than 1,000 branches. We look upon his experience in terms of dealing audit with Belstar to navigate this panel through. Then we have with us Charles. Charles Francis is part of the Chief Business Officer of Radiant, also the sponsor for today's event. And they have some very innovative financial cash management solutions. I think I will leave him to talk more about it, but suffice to say they have, as you have seen in the presentation, very strong presence nationally. 5,000 plus locations, 9,000 strong team, very, very strong operationally. We have with us an entrepreneur, Mr. Rajanar, a business leader, 25 years of experience, part of leading South India FinFest, which is I think 200 branches and more than 1,500 employees, if I'm right? 2,500 employees, on number keeps changing every quarter. Okay. So, and finally we have with us Anup TT. Anup is head of risk for Annapurna Finance, Bhubaneswar based, pan-India presence, 18 states, more than 1,500 branches, 10,000 crore plus portfolio. But Anup has been very, very instrumental in implementing the comprehensive credit risk, operational risk framework for Annapurna, so we will catch up on his experience today. Thank you all for being here today. With that, what we'll do from a structure perspective is we have 4 key topics which we will divide the panel into, and I will request each of the panel member to lead the discussion on that, and maybe others can support that. So I divided the operational risk aspect into 4 aspects. First is the landscape of the operational risk. What are we seeing? What are the evolving trends that we're seeing on the ground for banks, microfinance institutions, NBFCs, the whole landscape. Second, we will look at the recent RBI guidelines of April 2024, what it means for us How do we interpret that? What are the challenges in implementation and adoption of the same for all of us out here? And third, from the experience of the practitioners, we will look at what are the strategic frameworks you are using to implement these guidelines? What are the internal controls and tools and techniques that you found useful, some of which we hope the panel will share to all of us for us to take back. And last but not the least important topic, I would like to bring in a specific focus on the role of technology in terms of managing operational risk. So broadly, these are the 4 areas. And post this, I will come back to the audience for a Q&A. So if you have any questions, please hold on. We have kept aside significant amount of time for the same. So I just call upon Anup, who's sitting with me. Anup, I hope you have a mic. Anup, can you please talk to us about the landscape you have been experiencing over the last few years, and more specifically in the last 2-3 years, on how you see the evolving risks in terms of the operational risks?
I hope it's audible. Yeah. So, yes, people have given wonderful definition for operational risk, but to answer this, let me just limit it to problems with people, process, system, and product. It almost covers everything per se. And when it comes to people, the attrition and related aspect, I think it has been covered in detail in the earlier discussions as well. I'm going to skip that particular part. But just one point, a statement rather. The last March quarter, I think some of the reports suggest that total attrition is 60%, but field attrition is around 69%. So literally, if you are growing at 30% or 25%, in the next 2 years, you are going to end up with more than 80-85% staff as new staff without much of a training. That's a statement. I don't want to discuss it further. And covering the other aspect, there is a report called Banana Skin Report. I think CSFI comes up with it every year. So basically, what happens is they roam around and talk to risk professionals across the country, across the divisions, banking division. They ask them to rate their risk, what they identify as high risk. Interesting fact is when you ask it across the world, in the top 10, obviously there will be credit risk, operation risk. Other than that, there is data privacy risk, there is cyber security risk, there are other risks as well which covers in the top 10. But the same question when it's asked to the Indian audience, the data privacy and cyber risk never comes in the top 5. And unfortunately, we have a microfinance version of the same report. I think CGAP in combination with CSFI, they come with a microfinance banana skin report as well. There also there is no mention of the data privacy. The emerging, since we talked about the emerging part, I will talk about the fraud and data privacy as a second emerging risk for us. A lot of other risk has been there in the industry, everyone is aware of it. Fraud, yes, we are aware. Earlier what was happening, people running off with the collection money, that was very common. The limit of fraud was limited to 1 lakh or maybe 1.5 lakh. But now what is happening, which is not visible in the financial statements, is fraud that is happening outside the system, majorly because of the data breach. Now after this Jamtara, and that has the series has made it universal now. It's not just Jamtara from Jharkhand, it's happening from Rajasthan in every patch. But the moment my customer is getting money, the very next day she is getting a call. saying that दीदी आपके अकाउंट में हमारे X and Y कंपनी से अकाउंट से पैसा है, लेकिन दीदी वो तो गलती से आए थे. In fact, we have 1 lakh plus loan for you, but that one was by mistake. आपको एक काम करना पड़ेगा, additionally आपको processing fee में 5,000 देना पड़ेगा, 1 lakh का loan we will process. That is the kind of request we are getting. Last month itself, I got nearly 20 cases from Jharkhand and Bihar. Now it's in a rising stage. I mean, somewhere people are getting the correct numbers of our customers. They are calling these customers. They are making them convinced. They are convincing them to pay the fraud amount there. Considering that we are dealing with financially illiterate set of the customers, we need to be very careful about it. In fact, see, RBI has also made it clear. I mean, when they came up with the cyber jacket month, I mean now I think October month is the cyber jacket month for us. So we need to be very careful about this particular emerging risk. Similarly, now it's a time to think about the third party risk. RBI has, our regulator, thankfully, they are way ahead of the curve. They have already come up with a stringent regulation in this regard. Third party risk is something which we need to be very careful about. It's not the earlier microfinance operation now. From an origination to disbursement, I think in my own company there is like 6 or 7 API connects is happening. you have a KYC check API, you have liveliness check API, you have some of the bank NEFT or penny drop validation API. Then you have legal document, paperless API. There are 6 or 7 API which is connected in the system now. Have you ever checked the data point each and every API captures? I came up with a case last month. My team came up with this data point that said this particular company needed only 7 data points to work efficiently. But there are 2 additional data points they have asked for us. Somewhere we don't spend much of a time there. It's usually the IT team who discusses the API and finalizes them. But end of those 2 data points which they were asking were not even relevant for them, for that API to work properly. But somewhere it was getting out of the system, right? Third-party risk is something which RBI is very careful about. They have very clearly mentioned it in the IT governance structure, and similarly in the new operational guidelines as well. It's been very clearly mentioned. So third-party risk is something which I would say is emerging. It's going to come. We all are aware that what happened to Microsoft when some developer pushed a update all of a sudden, right? We had this issue happening last month only. So we need to be careful of third-party risk. The last point which I would cover is the regulatory risk in itself. I could hear in other discussion that regulatory risk is not much of an issue. I beg to differ in that aspect. Just think about the scenario where they have pushed for an ICAP regulation, right? But in the ICAP regulation, in the circular itself, they mentioned that we are not going to push the NBFCs to create capital for it, capital buffer for it, but you need to at least calculate the ICAP part. What if in the next year or so they would come up enforcing the additional capital requirement? Even if you go with the basic approach in operational risk, you are supposed to create around 15 or 17% of operational income as buffer. There in itself, if you add in those aspects like model risk, the technology risk, all aspects, I'm pretty sure you may then end up creating additional capital buffers as well. So we can't take regulatory risk as lightly at this particular point of time. We all understand that for better financial stability, we need the regulator to act on it, and we need to be careful about these aspects as well. Last particular point is model risk. Earlier it was always a paper-based assessment of customers and credit doing underwriting part. Now I think there are 7 or 8 scoring models available in the industry, readily available. But have we checked the parameters which is in federal system? I myself have an ML model. We have a XGBoost based model. When I was having this discussion with my team, they said that you have to black box it. Something comes to the data and it gives you a number. And I have a good number of rejection percentages. But what about those parameters? Are they updated? Are they clear-cut model governance that is happening? Are they updating the parameters? Earlier, the model was developed on the fact that it was only customer data which was getting fed. Now we have customer plus the not co-borrower but the family members' data. Are we updating those models? So we need to be careful about that model risk as well. I think I'll stop it here. I'll cover it.
No, very well put. I think to summarize, talking about your key priorities being operational risk in terms of attrition, risk of fraud because of data leakages, risk of third-party involvement in terms of data and your operational workflow, regulatory risk in terms of capital outlay, and what was the last thing you mentioned?
The model risk.
Model risk. Model risk itself is something which a lot of times we don't look at that at all. So I'll move to Mr. Nataraj. As a practitioner, we would like to add anything to this in terms of the landscape, any other significant risk that you think has been missed out or anything you'd like to elaborate on?
Okay, good afternoon everyone. I think just to add to what Anu was saying, I think in this industry, it's fast evolving. I think whatever was relevant last year is not relevant anymore actually. I think he talked about the fraud kind of risk, okay? And I'll just really go a little bit above what you were saying. Look at this industry, Jagadish, right? The mother of all the risk is the operational risk, right? Okay. Who ends up creating this risk more in the organization? Right? It is not the guy who sits at the top. It is the guy who really is very low at the organization hierarchy, right? Okay. And I think we often really overlook this fact that, okay, a guy probably was 11th or 12th pass or a graduate, okay, just coming out of the college, right? he ends up creating the huge risk for the company. I think it's a huge dichotomy actually. I think, on the one hand, you have really very, very subjective kind of an assessment model that we have, though RBI puts over the fact that the household income has to be 3 lakh and there's no definitive way of really assessing this 3 lakh household income, right? So on the one hand, you have that kind of a thing. On the other hand, there is a very, very subjective way of assessment. Okay, and then adding to this, a guy who's very at the lower rung of the hierarchy, okay, doing this assessment actually. I think this is, in fact, I would really share. Probably, if you allow me, maybe I can add to that. I think, what do we do with this, right? So, though I was handling different businesses before I came into this aspect. So when I looked at this industry, come on, there's something structurally wrong, okay? Compare this to an housing finance or a personal loan to a professional or any kind of an MSME or even corporate loan. That's completely different elephant actually. This is completely different, right? So I think the one way to address, this is evolving very, very rapidly. One way to address is structurally you have to change it. You have to really invert the structure. I think take the control completely away from the field officer, from an assessment model. Okay, now I think the way I look at risk, I like to share my experience with all of you guys. I think sequence is very, very important. In a financial services business, there are fundamentally three risks. And the one is the people risk. Second, I think he mentioned it. Second is the system risk. Third one is the customer and market risk, right? Now, but I think if you see, I think the reverse is not true. I think the customers will not, or external environment will not create the risk. Okay, if you have the perfect system and if you have the perfectly people process, right? So I think if you don't address the people risk firstly, if you don't address the system risk secondly, I think customer risk and market risk will really will be overwhelming actually. So what we do, some of the practices, I think Ms. Ramanathan talked about what we do uniquely. In fact, though it's a cliched statement, it's overused statement. I think in a very subjective industry, for me, more than the customer, the first really stakeholder is employees actually, right? Okay. Now we attach so much of importance to the employees. Okay, the processes, the way we recruit, the way we retrain, the way we really onboard. Okay, and then the way we take care of them actually, right? In fact, the pay structure that we have is probably one of the ideas in the industry, right? Both fixed and variable. We have a bonus structure on a monthly basis, and we give free food to all the employees across all the 9 states in the country, free. Now, so why do we do this? I think before you address the employee risk, okay, I think every other risk is irrelevant actually. Okay, if you build so much risk in employee, I think what was the system that you talked about? I think somebody mentioned in Bajaj Finance. I think Lal mentioned the 3 levels of the differences, right? I think if the employee decides to really do any kind of really fraud, forget about all the defense mechanisms that you built it actually. So that's why we focus so much on really making employees feel very comfortable. Okay, very, very. We provide a lot of psychological safety, so to speak. So I think that's the first tip that we do. Second, the system risk. I think it's fine. Okay, we have got a very, very motivated and really loyal employees. But I think there is always a tendency for people to really abuse an open space that's available, if not really structured properly. Right? Now, probably we are one of the few companies, if not the only company in the industry, where we record the household assessment and the credit assessment on the ground, okay, through an HO-based model actually. We ask the field officer to really source the customer, and then we do all kind of really algorithm and everything. The document-based assessment is done. We don't give loans to really any customer who will have a migration. For example, rented house, we don't give loans at all. So there are a lot of filters that we apply. We check for the house tax receipt and everything. And the EMI we check carefully, and the credit bureau score, which all this is as you said, it's already algorithm driven. That's fine. The second aspect is like what happens in the field. I think there are two things here. In an employee dependent model, okay, what is the guarantee that okay, our branch managers on the ground, they check 100% the customers, assess the customers 100%, okay, correctly, and then give the loan. I think it's very, very low actually. So now what we said, come on guys, you go to the field, okay, you send me the lat long, okay, and then I will make sure that the lat long is within the really the geotagging radius that we have, so 25 kilometers. So the HOQC team that sits there will send a link, okay. So the branch manager has to switch on that link, log into the link and have the conversation, right? And this is being monitored, not only being monitored, but also cross-verified by the guy who sits in the office, right? And this is recorded. So two things happen here, and this recording is kept for about 2 years, okay, during until the duration of the loan. Two things happen. One, see the diligence level of the employee, okay, goes up automatically. Right? Now we are really talking to a live audience, okay, this is being recorded, right? Okay. The chance of us really gossiping is almost next to zero. Right? Okay? The chance of us really doing something else absolutely. So this is what happens, okay, on the field with my branch managers, right? Okay, he'll be diligent. Okay? Of course to the extent that he is capable. Now, the second thing that happens is the customer also knows, okay, whatever C is saying is really recorded live. And then we also explain to it actually, this is good for you and all of that, okay? And we filter. So I think through this process actually, okay, we are able to filter out lot of really frauds that he was talking about, lot of really the diligence issues that is very typical of this industry, okay? The third thing, I'll just finish it, okay? The other thing that we do is, the customers come to the branch disposal meeting at the branch, right? Okay. Now, this is the only point where we really have the nominee coming to the branch, right? Okay. So even in this, for example, there is HOT which verifies the nominee because there's a lot of really frauds that go on, right? Because customers really who take the loan from us generally don't inform the spouse in the house about the loans he's taking. So of course, this is an household kind of an income, right? If one member ends, okay, it's very difficult for it to leave repayment. So basically, we filter out that also. We also have rejection of really 4-5%, okay, because they bring out, especially in certain part of the country, right? It happens, right? Then one more thing that we do is basically we also monitor the collection center meeting in real time through again a link. So what in summary, Jerry, this what we're trying to do is, okay, I think. Maybe are we overdoing it? In my view, we are not overdoing it. I think it's better to really be safe than sorry. Okay. In this, of course, my probably expense to AUM ratio is a little bit higher, but I would like to really compensate this through a very, very low credit cost. I think with this, I'm able to filter out the people risk. I'm able to filter out the diligence issue through my systems. And of course, if something happens, let's say. COVID happened, some really flood. That's neutral to everybody. Okay, probably I hope that through my filtration process, the impact for me could be little lesser, or maybe a lot lesser compared to the other thing. Yeah. Thank you.
Very well put. I think if I may just summarize for the sake of audience, I think what Mr. Natarajan is trying to say is people risk is his key risk, and attrition is his highest risk. So he's attacking me two ways. One with better retention benefits and model, which is implemented very successfully. And second, he's also trying to centralize capabilities. Right? So instead of having over 100 branches, diversified capability building, I'm trying to centralize core capabilities and build them and strengthen them so that I can be able to manage the risk better. Very well, Mr. Thank you. With that, I will move to Mr. Wilson Sirak, sorry. Wilson, you're a banker yourself, you've been in banking for 30 years. You've seen the new RBI guidelines coming in on operational risk management and with specific focus on building resilience. I think there's also talk about building capital buffers to meet expected risks from arising out of operational risk. What is your, can you enlighten us in the audience in terms of little bit details in terms of what exactly these guidelines mean for all of us in terms of the underlying principles, underlying accountability for all of us? And how do we go about implementing? It seems like a pretty complex document running to 65 odd pages. Can you simplify that for all of us here?
Thank you, Jagdish. I'll try my best to give an overview of the latest RBI guidelines on operational risk management. As we know, that was released on 30th of April current year in 2024. There were few guidelines and guidance notes earlier, but in this guidance note, RBI updated everything and added something new also. So this deserves lot of attention and lot of careful reading, lot of discussion also required, because a lot of new things are there that is to be implemented ideally by the banks and NBFCs also. This is applicable. Earlier the RBI guidance notes on operational risk management was applicable only for banks. Now this is applicable for NBFCs, cooperative banks, and other state level financial institutions also. So this needs a lot of attention, and implementation is maybe a challenge for many. For banks, this may not be quite new, because already many of the practices they have been following based on the earlier guidance notes and advisories. But for many NBFCs, maybe the large NBFCs, the top layer ones, might be having many of the good practices. But for smaller NBFCs, what I feel, many of the aspects or principles mentioned in the guidance notes are quite new. So it may be a big challenge for them first to understand what is required and to implement it in their system and their operational risk management framework. The name of the guidance note itself is slightly different. Guidance note on operational risk management and operational resilience. Already operational resilience, Reddy Mohan Sara talked about that. Operational resilience. After the pandemic, COVID-related pandemic, a lot of focus is given on operational resilience. In fact, this is all based on the Basel Committee guidance notes on operational risk. RBI has taken from the latest guidance notes issued by the Basel Committee on Banking Supervision on operational risk management. They had added operational resilience as an important part of operational risk management. In fact, it is the outcome. It is the desired outcome of operational risk management. Operational resilience means the ability of the organization to provide the critical services during a disaster or in the event of a disruption. Whether it's a natural calamity, it's a pandemic, or a strike, ban, anything like that. Essential services for the critical operations, the operation should be able to provide and continue. The entire operational risk management should focus on that. Ultimately, that is the outcome, desired end result of operational risk, a robust operational risk management practice. 3 lines of defense they have covered in the guidance note. It's also already discussed. First line being the business team, second line the risk management team, third line of defense is the audit team. And in the guidance note, it is clearly mentioned what are the expected duties and responsibilities and roles of each of the lines of defense. For example, the first line of defense should know, they should be aware of the inherent risk in each product and processes. It's not left to the duty of the risk management function. That business itself or the frontline manager should be aware what are the inherent risks. and they should try to avoid that or manage it in an effective way. For risk management function, also expected to lay down the policies, processes, periodically doing the risk assessment, and identifying the risk, new risk, emerging, sensing the emerging risk, mitigating it, finding out methods to manage it, and their role is, or the more important role is to report to the senior management and board, sensitize the top positions in the organization. Everyone should be aware that what is happening, where is the risk leading, the level and trend or the direction of the risk. And audit is giving the assurance that everything is fine, the risk management is taking care of their duties, all that things. In their guidance, RBI guidance notes or that structure is developed on 3 pillars. That is what the regulator calls 3 pillars. Briefly, I will tell you what are the pillars. Pillar 1 is prepare and protect. And again, across the pillars, there are 17 principles, various principles covering specific areas. What are the expectations? What is best practice? What is the guidance the entity, either a bank or an NBFC, is expected to develop, implement, and improve for a robust operational risk management framework. Pillar 2 is building resilience. Build the resilience that we have already seen. What is resilience? Operational resilience. That business continuity, ability to continue the business even in a disaster situation, even after something bad happened. Pillar 3 is learn and adapt. That's also very important. These pillar 2 and pillar 3 are new concepts. It was not there in the earlier principles, earlier guidances. Third one, learn and adapt. That is, learn from your incidents. Do a thorough analysis of what went wrong, what happened, what led to the disruption, what is the reason. Do a root cause analysis and understand from that, learn from it, and take all the measures, what are the corrective actions required for preventing the repetition or not happening it again, and to minimize the impact in future. To get ready, learn from your mistakes, your experience, and adapt the best practices to prevent it not happening again. Again, that principle, 17 principles under these 3 pillars, these various principles are laid. I'm not going into one by one listing out the principles, but what is something new or maybe a little more attention is required, I will just share with you. Governance and risk culture, that is, we all know that from board, it's a top-down approach is the practice in good risk management. Everything should start from the board. They should set the tone in risk management. Then for responsibilities of senior management, identification, assessment, that is the normal risk management way. We do identify, assess, manage, mitigate, and report. Then something new they added this time is change management. There are clear guidance on managing changes. What are the changes? Any new product, new processes, new geography, new set of business, new set of customers, all these are changes. Or new technology, new applications, new software, everything is considered as a change. It's a challenge. Implementing the change is a challenge because we don't know what will happen after implementing this change. So you should be aware, you should assess well before implementing or going for the change. and limit the adverse effects of any change. Study it well before implementing. Change management, they introduced as a new concept. Monitoring, reporting, control and mitigation, that's all there earlier. Then something new they introduced is mapping interconnectedness and interdependencies. There are various functions in every organization: giving loans, selection of loans, monitoring of loans, collection of repayment, then recovery actions, everything. Various functions are doing. That interconnectedness, how one function is dependent on the other, how it is critical, how one function is playing a critical role in ensuring the business continuity and operational resilience. That should be mapped and there should be a clear understanding of that. Third-party dependency in managing operations. That is very important. Third-party, it is something more than outsourcing this, managing outsourcing this. We are outsourcing a lot of functions, collection agencies there, vendors are there for various operations as discussed here, cash management is, we are outsourcing. More than that, third-party relation, third-party dependency, we should know how it will impact our survival or our services. We should have a clear idea to what extent it will impact each of our critical services, and we should have a plan for mitigating the risk arising from that third-party dependency. Business continuity, it was already there. Incident management, from each incident, how we are managing, what are the responses, what are the corrective actions expected, that all should be documented. Anticipating some incidents and how fast and how quick and how best we can respond to it, so that we can limit the losses or bad impacts. Information technology, cyber, that's all known to us. Learn and adapt, it is a new concept under that. Disclosure and reporting, that is something part of the guidelines, but I am not clear about how they expect the bank or NBFCs to do a disclosure about the operational risk side. Of course, in our website, we are supposed to publish our risk management practice in a brief way, but each and every incident or a disruption that happened to us, how we should publish it or how it is to be disclosed, I'm not sure. Maybe there will be clear guidelines coming in the future days. One thing they specifically mentioned that the disclosure should not lead to further operational risk. So that we should not publish what are the open vulnerabilities, so that somebody else should utilize and exploit it and play a game. That is another new concept introduced is continuous improvement through feedback system. Feedback from where? By whom? That is from all the stakeholders. We are supposed to get feedback from all the stakeholders. It can be staff, frontline staff, middle-level managers, senior managers, board members, external vendors, regulator, auditors. Everybody can give their suggestions, feedback, and based on that, we are supposed to improve our operational risk management function. This is a summary of the new guidance note issued by the RBI, and a careful study is required because we have discussed hours and hours together, though many of them, most of maybe 75% of the concepts are already implemented in most of the banks, but maybe what I feel is that mid-sized or small, even smaller NBFCs may face it as a slightly bigger challenge to know about it and to implement it. RBI is not prescribing anything specifically. This is the way you should do. This is the design. This should be the design. This should be the form or formality. They are not prescribing anything. This is guidance note, but these are essential elements for a robust operational risk management framework. When they come for audit or regulatory inspection, definitely they will look into all this aspect, though they are not calling it prescription or a must to do or a mandatory thing. Course of time, when they come for audit inspection, they will look into this aspect, whether this institution is having this practice, they are following these guidelines. So it is for the best interest of us to voluntarily go for the new guidelines that will give us relief from the regulatory observations and all that thing. And more than that, it will give us a lot of comfort that from the international scene they have picked up, internet by BCBS had picked up all this from their vast experience and experience of all their member banks put across all the countries. So there must be something big and something good for everyone for going and implementing this. Thank you. Thank you for listening to me. Thank you.
Thanks, Susan. That was 65 pages condensed in 6.5 minutes. Very well put. I just happened to read this circular 2 days back, and if I had known you were condensing it, I probably wouldn't have spent so many hours. Great. But the regulator, really in his knowledge, wisdom, regulates, deregulates, now is also giving guidelines. These guidelines literally look like a blueprint on how your operational risk framework should look like. The regulator has invested far beyond regulator function into all of our well-being and customers, customer and the regulated entities. So really, if you take these guidelines to spirit, there's definitely a lot we can all implement and learn. I think, Chandran, coming to you, not only the regulator gives guidelines, but there was recent, I think we all know that there was this large private sector bank, which, because of a 10-hour disruption in service to its customers, had to face serious curtailment of its expansion of business operations. They have not named the bank, but we all know that there's been such. So, regulator not only takes, gives guidelines, but also takes this quite seriously in terms of ensuring, as Susan rightly pointed out, during their audits and scrutinies. Can you share with us some experience from your side in terms of how serious is RBI in terms of these operational risk guidelines, and what's been your experience in dealing with that?
Yeah,
It's on.
Yeah. Thanks, sir. So, am I audible? Hello.
Yeah.
Yeah. Thanks. So I think I would want to share my experience. I mean, I had an internal audit with Belstar, and operational risk probably is, I would say, is probably bigger than credit risk. I mean, in the sector that we operate. And if one were to see operational risk, I would put a huge weightage to behavior. I think behavioral risk itself is an area of study. I think most of the banks and NBFCs are present pan-India. And if you were to actually go deep into the portfolio, you would actually realize that within one company there are 4 different companies operating, primarily driven by different people behaving differently. So it's not that people do not adhere to policy or procedures, but they tend to explore different avenues of or channels of achieving their target or the collection part. So probably, just to quote, probably if you are enabling a feature in your loan management system, which is probably to allow genuine rejections to not happen. Just as an example, I'm just quoting. So what might happen, or what we have seen during the course of our audit, is this genuinity is somewhere lost in the process. Somewhere people try to play around that to, push in something which is something which ideally shouldn't have been done in the normal course. So that way, as audit, we try to do. We probably feel that the sales officers are actually smart. To be honest, you have a set of people who are dormant and not so good, but there are the real guys who are actually quite smart enough to beat the system and which actually has an impact on your overall portfolio. Not just portfolio. It could be impacting you regulatorily at different at some stage as well. So I think what focus that we have been. I have been advocating to my team is split it into two. You do the audit at the field level, so you focus on meeting customers and try to understand. That is always there. It is always going to be there. The other area where you need to focus is on data analytics, and that is a challenging thing to do, given the background of the people that we recruit. In microfinance, their ability to dwell down and look at data, interpret data. Data is so voluminous. You need to first try to distinguish between what is good data, what is not needed. So that amount of training is required to the team, and it is not sufficient that you just train them. You just need to keep you need to ask them to actually inculcate it in their regular practice, and then come out with suggestions. So that way we have been specific to behavior. We have collected certain data points, which we have kind of automated through a tool, which comes as a summary on a daily basis. So this is somewhere. This kind of helps us in tracking the behavioral aspect of people, and which is a key operational risk that we foresee. And RBI has been. If you were to see the audits that RBI has been doing in the last 2 years that we have encountered, they are completely behind data. Their audit is completely focused on data analytics, and in fact, certain things which we tend to miss, they have actually been proactive in identifying. So I think the sector requires a lot of data points. You need to distinguish between which data is good, which data is probably to be given second priority. So definitely RBI is one step ahead, and I think the number of the NBFCs to whom RBI has also been issuing memos or raising some penalty has been on the rise. In the last 1 year, so it is very clearly noticeable, and I think as responsible lenders, a lot of weightage has to be given to compliance and risk management, and we also should probably know how to balance business and compliance. I think business should always be kept in the loop in terms of every risk management decision that is taken, and not that they are not party to it, but I think the amount of sensitivity that needs to be driven down should be on the rise, is what I feel.
Thanks, Chandra. That's very nicely put. So essentially, what you're saying is RBI is not just contained with looking with random paper or random samples, but they're actually looking at serious data analytics and trying to ferret out where the issues lie. So that's something which a lot of us may not be prepared for, given our past experience with regulators. So what he's really saying is, it's very important for you to be having your data analytics right, as well as your monitoring systems on the data right. Thank you very much. So I'll now move. We have discussed about the landscape and the regulator and the guidelines. I will just request Anoop and Natarajan. I'll come back to Charles in a while, but I'll request Anoop and Natarajan out here to tell us their experience in terms of what sort of frameworks or what sort of strategies have worked in terms of implementing some of these guidelines. What sort of tools and techniques are you using to improve operational controls. So I'll just request Mr. Natajan to take the mic first. A little bit brief, please.
Yeah, I'll keep it brief. One thing that we say to ourselves is, how do we get everything right, okay, every time, but in real time? I think that captures the essence of what we are trying to do within the company. Actually, I know in lending business and more so in other businesses as well, but in lending business it's very particular. Once you make a wrong decision, you can do post-mortem, but it's done. I think for a 50,000 rupees loan, a 60,000 rupees loan, I don't think you go to court and then get the money back. So I think as I was explaining to you before, okay, that's the top line kind of frame. Okay, in anything that we do, how do we get everything right? Okay, every time, but in real time. That's where the technology comes in. Right? Okay. eKYC, it's common now, everybody uses eKYC, so most of the frauds that used to happen with Aadhaar and voter ID, it's all done, right? And of course, we use only like Aadhaar and voter ID as the main two eKYC documents, not PAN, because they only common in between pre-Aadhaar and present really system is the voter ID. Okay, so if you miss out on the voter ID, for example, you're losing out on the old data that probably customer was having, right? So anyway, so that eKYC is done. Okay, then we use the Microsoft Teams very heavily. Okay, all the really like videos that we record gets really stored in the cloud system. We can access it. Right? I think one more thing that we do, it's very important. How do we create a process trail, right, so to speak? Because what happens is somebody does the sourcing, and then somebody clears it from a QC1 perspective, and somebody does the house verification liquidity assessment, and somebody does the branch disbursement, right? Then finally, the money is sent actually, So now what you try to do is there is an LOS and there is an LMS, and there is something in between. I mean, this is the name that we given, which is called like an LPMS, Loan Process Management System, right? This is where, most of the really the controls and really processes that we've built in, is this here. Because I think, we are in a hyper growth kind of really industry. I think if we don't grow 30% every year, I think there's something wrong with you. That's how we are looked at, right? Okay. So when we grow, this fast, right? And that too with really different states. Okay, there's no homogeneity in terms of the behavior. He talked about behavior, and I very much agree with that. So how do you really unify most of the really behaviors, right? So with this, the complexity increases when you grow 30%. Okay, with really multiple geographies, right? The complexity increases, and then efficiency goes down. And of course, this is a perfect recipe for really risk really being built into the system that you're doing, right? Okay. So one of the focus areas that we've really done is between LOS and LMS is very straightforward. LMS is very straightforward, right? LOS basically most of the thing. But I think what you do in between LOS and LMS is the main differentiator, for your portfolio quality. So we deploy multiple tools. For example, right? I can look at the customers who are onboarded today, and for how long they've been sitting, right? Okay, did they get formed into a group or not, right? If not, why not, right? Okay, and then what is the really conversion ratio, from onboarding all the way to the disbursement? This is all real time, by the way, okay? And collection dashboard everybody using, we are also using, right? Okay, and how do you create? From QC1 to house verification, to the branch disbursement, and all the way to really the actual thing. Also the collection center meeting. I think creating this kind of a process trail, I think in my view is going to be the fundamental differentiator as we move forward. But as I said,
is this something you have built in-house or something?
This is something we have built in-house actually. Okay. So now, again, we constantly evolve. I think as I said, we grow. As we grow, this industry has a really a cycle time of, let's say, what? 12 months, every 15 months alone, really, if you see, it gets replaced, right? So the behavior of the customer keeps changing, the behavior of the influencers, so to speak, they also keep changing. So I think we need to be very process driven, make sure that you're really building a process trail, and then you should be very nimble enough to tweak it, okay, whenever there is something emerges, okay, out of the system. So I think, in my view, this is very, very important, okay. If you're able to do this, I think the quality of the portfolio will speak for itself.
Anup, you have implemented a comprehensive risk management framework in Annapurna. Very complex automations spread across the country. Can you share some learnings from that implementation which could be useful to all of us?
Natarajan did also cover all the initiatives we as a company take. In fact, I'm not going to touch upon those points, starting from a BRE or other aspects of risk management. So, covering the other part, which you rightly pointed out, risk management framework and ERM structure, I would say that this is the right time to invest on ERM and related aspects. We microfinance institutions usually cover risk, credit risk and operational risk to some extent, but we have never thought about it as an enterprise risk management. Somewhere we need to integrate and have all the risk elements at one space and identify what is going to be the combined effect of all those risks which we usually look at silos, starting from credit risk to operational risk, even the market risk, interest rate risk per se. We should have it at one space. So basically, what we as a company we have done, thankfully, in God's grace, we have a larger pocket to spend on these fancy tools per se now. But having said that, we have invested on a ERM solution which kind of automates the whole workflow regarding enterprise risk management. It gives us a scope for working on EWS, early warning indicators. So early warning indicators that those points which we talked about, the operational risk aspects in the field, whether fraud happening, whether lack of training which is there, a new risk, right? Risk rising in the field. You need to have an instant view of those risks at the head office. You should have a quantum of loss which may arise out of this particular risk event. For that, there is a need for spending in EWS. EWS can be a very simple BI tool, business intelligence tool. You have Power BI or for that matter. Basically 7,000, 8,000 rupees in a year is what is the cost in Power BI. The plus point is that you just link it to the LMS system of yours. You will get instant insights to it. You subscribe to credit bureaus. These are very minimal expense things which one can have. Obviously, Annapurna has spent a lot of money, I would say, and near to 1 crore in the last 1 or 2 years just for ERM and related solutions. I'm not asking everyone to do that, but these smaller steps take us to that level. A Power BI linked to the LMS, just benchmark your collection efficiency of individual members, and now just link the same or benchmark the same with the PIN code level report from Credit Bureau. You have a report saying that, okay, in Madhya Pradesh, let's say Ujjain side, I have one particular credit officer whose collection efficiency stands at 93%, who one plus delinquencies maybe in a range of 17%. But industry in the same PIN code has a 1 plus delinquency of, let's say, 4%. So there is a gap of around 12%. One, obviously, the staff may not be experienced enough to get that money. The other aspect is obviously fraud risk. He or she is doing something not expected in the field. So that can be indicated. That's a part of EWS per se. Now coming to the ERM part. Spend some money, ask any of your fields, risk managers to do a course in COSO ERM framework. COSO ERM framework talks about things which needs to be there in an institution to frame, for a minimum ERM development. Or else, what Sirik mentioned, follow the 17 principle which RBI talks about. Create a checklist. Just benchmark what you have in place of the same aspects. So those are minimal things that one can do. The other aspect being, what we have recently, an interesting part. It's not my original idea per se, but somewhere I heard it and we tried to implement in Annapurna as well. A lot of innovative ways of doing operation risk is happening in the field. A lot of innovative ways of doing fraud, innovative ways of coming with operation risk. Get a feedback from the field. Bottom-up approach is the right approach to identify your risk. What we have done is we just piloted it. We have linked it to our HRMS. Everyone has an HRMS for people who just check in their attendance and mark their attendance, right? While doing the attendance mark, ask them what is the new risk which they are facing. It's 100% sure that you have 80% field staff in the field, right? Someone who is not into committing fraud, they would just point it out. Sir, what I have seen is there is a gap in this particular process. Someone can exploit the gap. Maybe he or she has seen her branch manager or a field staff doing that. Collect that data. You would have end of the month. You would have, let's say,
what I have is around 500 plus cases such new cases. And in fact, I think around 13 or 15 new cases also came up in that report itself. People saying that, sir, there is a gap in this particular process, plug it down. So those are things, with minimal expenses, what you can do in a system to make sure that you have a good, risk management.
No, I think very nicely. You want to add something on that? Please.
Gigi ma'am, this is for you and also Karthi for all the practitioners here. We keep talking about 2 lakh outstanding. Don't go beyond that. Okay, I mean that's a new guideline that you come out with, sir, last month, right? I think there is one fundamental flaw that we have as an industry that we have. Are we updating the disbursement? Okay, that is we are doing to the customer in real time. The credit bureau? No, we are not doing it. We're doing it 1 month later. You know what? The tag for a microfinance loan is about 3-4 days. Okay, when a customer applies to a loan, he doesn't apply to one particular lender. He applies to 3 lenders, right? What happens is, so by the time he has checked and I have checked and he has checked, okay, and outstanding was the same thing. Okay, but we don't update it. Okay, for one month. See, regular outstanding update can happen once a month. But I think this is very important. I think as an industry we need to drive this. As soon as the disbursement really goes from the bank to the customer, it should get updated in real time. So because otherwise in 10 days you will take 1 more loan. In 50 days you will take probably 2 more loans. I think that's a fundamental issue. Otherwise your objective will be
challenges that you see when working with the sector?
So I take this opportunity to thank Sa-Dhan and this eminent panel for giving me an opportunity to be here. And I'm an odd man out in this August gathering. Okay, I understand a little about this, but I can tell you how we can play a very big role in the peace of, because I see the CXOs here giving you the peace of mind. Before I talk about this, I think it's important for me to talk about the organization I represent. So, Radiant Cash Management Company was founded by Colonel David in the year 2005. He was an infantry officer from Gorkha Regiment. We have around 18 plus regions operating throughout India, and all these regions are headed by colonel level officers. We have a 10,000 plus workforce, out of which more than 20% are from the armed forces. So what we call it as the military ethos, which includes your sincerity, integrity, security, safety, runs in our DNA. And we are India's largest cash management company. When I say largest, we have business points, around 60,000 touch points across India. That means from Kashmir to Kanyakumari, from Jamnagar to Northeast, we have the capability to pick up cash
from any, it could be a retail, it could be microfinance, or anything where the cash needs to go to bank. That's where we offer this service. And we had operations in Andaman. In 3 months back, we started in Lakshadweep as well. So across India, wherever you're expanding and you have a branch where the cash needs to go to bank, we can help. And when I say we are the largest, we handle around 550 crores a day. And last year we handled 1.75 lakh crores. And the record we have is on a festival day, we handled 1,000 crores in a day. So that credential will give you the comfort, so with whom you can partner with for your progress. Okay. So what we primarily do is we pick up cash. It's very simple service. Pick up cash and safely and securely put it in your. What I understand is, as I see today's business context, it's very difficult to get a customer, give him loan, and it's more difficult to collect money from him on time. And the key factor is when you collect that money with so much of difficulty, you have to reach it to the bank. That's the way you recognize your revenue in the one. But there are many challenges in the field that includes cash at the branch results in fidelity where the employees themselves take the money. Then interesting is like they give money on rotation. They give 1,000 rupees to the cart vendor, the smaller shops, and they collect 1,010 rupees the next morning. So plus the visibility of a CXO at the end of the day, how much money I received, how much that goes to a bank. Is still maybe a few of you have adopted technology to know. This is where we come. Wherever money is collected, we give the visibility across outlets, be it 1,000 or 500. As a CXO sitting in your table, you can get a report which says we collected this much is credited. This is first thing. So ultimately, at the end of the day, doing business, you are at peace because money has come to your bank. And we offer multiples, right from the biggest bank to the biggest retail are our customers. All banks we work with, right from Reliance to Ecom to Amazon to Central Railways to all the major microfinance companies work with us. So we can help you in multiple ways. One is a simple cash pickup, and we have much more technology related things as well. One is we recently, as Nimisha was explaining, we acquired Radian, majority stakes in Radian Cash Money. So we have the physical plus the digital capability. So we are building BC points as well. So we have physical cash executives who can go and collect. We will also have the capability wherein you can deposit cash in our BCs as a whole. And recently we launched, when we talked about technology, what is called as InstaCredit. This is primarily, we started it for small retail segments wherein we go, my cash executive goes to the outlet, collects the cash through the app, he immediately credits it to. This is the first time in India. This concept came from US, from a company called Loomis. They run with a cash machine in every road, wherein the outlet guy comes, puts out codes and deposits money, he gets the credit immediately. In India, it's difficult to do because you run a cash van and you'll have a big traffic jam index. So we replicated the Indian way. We are good in technology. So we made an app wherein the cash executive, when he carries it, he collects the money and immediately gets it credited, meaning we funded the day one. And the best part is the cost at which we give it to you. I'll give you a small idea. For collecting up to 50,000 rupees a day for 24 plus 2, that is 2 Saturdays included, we charge hardly 3,000 plus tax for an immediate credit. So this is only for small, not for the bigger. It may not work economical for people who have more than a lakh. For that we can offer a direct pickup and deposit. And at the end of the day, why I'm saying is, as CXOs and head of businesses, you can be at peace because you know what has come and what has gone to bank. Thank you.
Thanks. The interesting point is outsourced services are available for everyone, whether it's a 50,000 crore company or a 1,000 crore company or a 200 crore company, probably not to differentiated costs. Right? So there's a lot of way we can smartly use third-party services while managing the overall operational risk framework to bring down, to match the capabilities. Interesting point. So with that, we have finished the panel. So I will leave the floor open to the audience if they have any questions. I'll just request someone to help the mic to the audience because we will take very few questions, maybe just 2 or 3 because we are cutting into lunchtime. Yeah. So. We have the mic there. I know who the questions. Anybody in particular, the panelists you are directing it to?
Not to the panel. I'm Santosh. Thank you very much. Thanks to panel members. Both panel members for enlightening on risk aspects. Basically, few measures also we have discussed since morning. But just my request to put a thought to the panels. If you see the industry is working in a very aggressive mode, and the management level we are putting pressure and giving taking these aggressive measures to have a more business, and also we are giving emphasis to the field staff to do all these things in the field level. So whether it is creating any risk or we are not in that aspect, only this data and numbers you will see. Your thought, please.
No, I mean, one of the things that we talk about in the company is quality and speed. Okay, you have to have quality before you speed up. Okay, I think if you're too good, if you're having too good quality without speed, I think it's not that exciting. And if you don't have quality and if you speed, actually you meet with an accident. So I think it depends on the company's ability to handle the growth. It depends on the company's ability to handle the complexity, and then how do we really weave technology into process and really reduce the complexity. I think if companies can manage that kind of really marriage, fine, you can grow. Otherwise, it's a problem. I think it's a genuine problem actually. I think normally when they say okay, when the going is good, it's fine. But when the going gets tough, actually few who have thought through all this well in advance and put proper systems, then I think realizing it later is a dangerous thing in this industry. I think
Almost just what he said. You can go aggressive. There is nothing wrong in it. A high rate of growth is okay, provided you have the right checks and controls, systems and processes. It's not leading into any difficult situation later. Make sure that it is all quality growth, it's all following all the norms, it's all well within the permitted framework. I will just share an example in one of the institutions, in one particular branch, loan growth was tremendous. It was a very big spike in a very short time. Everybody congratulated them, recognized, they got a lot of incentives, everybody. Then finally, it proved, because after a few months, there was no repayment, NPA was mounting up. Then it was found out that it was all fraud. Loan was not given to the real borrowers, somebody who had already availed the loan, because all the KYC, everything is in the system. Their names were used, loans were given, and with that sudden spike in business was there. So everything should be checked, controlled, and make sure that this all done in the proper way.
Next question.
It's not a question, I have a suggestion, because the two panelists, I think Sa-Dhan, the suggestion is given to Sa-Dhan. Two things. One, we're talking about guardrails, we signed about code of responsible lending. After signature, COVID came and you left it. So my suggestion would be, in terms of guardrails, I think there should be a trust and verification process. What's happening after 3 months on these guardrails? Natarajan did touch upon the fact that about everyday reporting, right? So we talk a lot of things. We put the guardrails, but are we doing a lipstick? Are we all following? That's one suggestion. Could be I'm too small to tell this, but I felt it should be. The second suggestion is a sharper suggestion. We're talking about the importance of field resource, right? We're saying they're very critical people. I would suggest, I don't know whether it's possible or not, but each of the organizations should get a field resource to be part of the panel. I think what we talk at the higher level, what we learn from them, could also be very critical for us to take things forward. This is a suggestion to the panel to start. Thanks.
Good point. Any other questions directed at the panelists? Yeah. Mike, please. Nothing.
Good afternoon. My name is Uttam Nayak from the Financial Services Private Limited. My question is that as per the RBI guideline, we are disbursing the loan to the underserved people who are not getting loan from the banks and who are not getting through the secured loans. We are giving the unsecured loans to the borrowers. At the time, after disbursing the loan to the underserved people, after giving 2 or 3 EMIs, they are left their house and migrating from their own house. So that we are a pressure how to repayment to the BCs, how to repayment to the funders, and it is the migrating issues for the all the MFIs or NBFCs. So how to managing the migration issues in the field level? In so many cases, we are observing that facing. How to observe and how to keep to kids for them, and we are also measures through EQIC. Everything also done. It is not anything else issues from our side. But after that, how will we measure the migration issues from the field level? This is the great issues from us.
Can you my request to take this question?
Yes. So I think migration issue is we have to live with it. Is what I feel. I mean, it's going to be there. How do we handle it and how do we have control over those customers is where we can probably look at developing our capabilities. So I think customer migration is one thing. I mean, probably he's not in his house, but at least if you can ensure that he is contactable over phone. So probably one measure that you can look at is using his Aadhaar linked mobile number as the primary contact number. So probably your onboarding should probably be strengthened to ensure that you do an OTP validation of his Aadhaar, the family Aadhaar number. That is one way of looking at it, one thing that you can put as a control. The other thing is, if he's a genuine customer, if he's migrated to an area or a branch where, a location where you have a branch presence. So probably you can also develop your, core banking solutions where, that respective branch can also follow up with the customer as far as collection is concerned. So probably most of the models that we have currently, it is more of the branch which is actually sourcing the customer is following up with the customer. So probably if we can develop capabilities like similar to a bank, where core banking in true sense is implemented, whereby the customer is able to deposit in a local branch. And of course, you can also develop on digital capabilities, probably like a QR code in your loan document, which makes remittance easier. So I'm suggesting mediums through which the remittance can be done. But migration as an issue, the one thing that you can look at is at the time of sourcing. I think some basic checks needs to be done. So probably if he's found to be somebody who's not having a own house, I think your diligence there, you probably need to establish that he's at least been in that location for a minimum period of time. So those things will have to be strengthened to ensure that you have control before you actually lend the loan. Probably others can.
Thanks. I think very practical question and a very practical.
Time for one more or no?
So we take one.
Absolutely fine. You can't say no to the staff. One fine. Quick question, sir.
It's not a Did you talk about BRE? Yesterday night I received this about the BRE from one of my friends in the top 5 MFI. Can you say something about that? Will it be sorry, I can hear that. It is something about Anup mentioned about the BRE. I don't know anything about that. Yesterday night, late night around 10 o'clock, I received this from my friend who is in one of the top 5 MFI. He says this BRE is helpful in efficiency, loan processing, customer acquisition, product innovation, audit trails, etc. How expensive it is, whether mid-level
below 5,000 crores MFI or below 5,000 crores MFI can afford this or no?
The cost, PRE stands for Business Rule Engine. There are two ways. So basically, it's a brain where you can put in a lot of rules and rules and policies, and this particular system would help the LMS or help the LOS in capturing those rules and policies and give you outcomes. So basically, I feed in all this information. Like let's just talk about the guardrail here. Guardrail has come up with a list of 4 entities and then 2 lakh rupees and everything, right? So these are rules and policies per se. So LOS can give those data points to the BRE, Business Rule Engine, and the Business Rule Engine in seconds can give you outcome, whether the customer is okay or not okay. Coming to the exact question of costing part, so to reach there, there's a Forrester grading for Business Rule Engine, starting from strategy 1. There are a lot of BREs out there in the open market. Some of them even cost 2 crore plus. But there are cost-effective methods as well. I think the common ones in the industry right now cost around 30 to 50 lakh per year. And there are new innovative solutions which are shared across entities. I think this would come up at 25 to 30 lakhs per annum. But the plus part, the beauty of having a BR Business Rule Engine is that you can change policies in matter of hours. We talk about guardrails, right?
At your end, itself.
Yeah, at our end, sir. We are not at the mercy of contacting the LMS provider, waiting for 3 months of time period to develop the new system in place and implement it. Let's talk about the guardrail part. Literally, I have a BRE team that comes under my purview. They made the change in 25 minutes. Stop. 25 minutes is what they took in making the guardrails applied in the credit policies. That is the fast in which BREs would help you in getting things done. And the last point is hosting these ML models and stuff like that. The LMS providers may not be having the system to host it. I have 3 machine learning models. It is hostable in the BRE. So that is what matters. Gives you that.
Thank you.
Thanks. So I'll request if anyone has any questions, take them during lunchtime. Panelists are available. So I'll just call this panel to a close. Before that, I would like to thank Sa-Dhan for bringing together this wonderful panel. We have both the first line of defense, second line of defense, and third line of defense, plus an outsourced third party. So very well thought through panel. Thank you very much. And thank the sponsors and thank all the panelists in particular for being patient, and thank you, wonderful audience, for being with us.
Thank you, Ravi sir. And also the other panelists. Now I request Mr. Gigi sir to give the token of appreciation.
Sa-Dhan board member with us.
I'll also request Ms. Nimisha to join for this.
Energy is our board member.
Yeah, of course. Thank you very much.
Sir. We can stand the front.
So this one again. Little close. Little close. Smile, sir. Smile. Okay. Thank you.
Thank you.
Next, we have a presentation on risk management solution in microfinance by Mr. Ganesh Gopal.
What are the risks are available, operational risks are available in the industry, in the microfinance area, and also in the banks and financial institutes. The information was very much insightful. So, following to that, I would like to talk and touch upon that how the risk management solution can be implemented for microfinance. So everyone was from the, I would like to thank panels who have been talking about risk management, how the operational risk framework has been created in the organization, how the organization to be protected, all those areas. But at the same time, the technology is going to be the backbone for any solution or a framework which we need to do. So that's where I'm going to touch upon the risk management solution. Basically, I'm Ganesh Gopalan, founder and CEO of Lisms of Technologies. So first let me thank Sa-Dhan for organizing this fantastic conclave about risk management for microfinance. They've been doing a lot of things in microfinance area. I've been following their posts. So they are trying to put all their thoughts and helping all the microfinance and see how this can be improved for their day-to-day operations. So since morning we have been talking about risk management solution. So what are the basic 4 pillars we have been talking are there? How you identify your risk. So the first process would be your identification of all your risks within the organization. The second would be how you are going to assess the risk, whether this risk is going to impact my business, how much it is going to impact, what kind of risk it is going to be. So that's the second key element which you will be talking about, how the risk is going to be potentially impacting my business. Third is how I'm going to track my risk and how severe it is to the organization and how I'm going to monitor and mitigate that. So this is the third portion of the risk management. And fourth is my mitigation process. So this is a very, very important. Monitoring and the mitigation is very, very important for the organization. Just identifying the risk and having it in a risk register is not going to help. However, it has to be properly tracked and monitored. So when we talk about, see, these are all, we all know about this. So these are the 4 pillars. We talk about Basel, we talk about COSO framework, how you do all this framework has been built. But how it is going to get implemented in the organization, that's more important. So if you look at how the technology is getting evolved over a period of time, so when we started way back in 80s, I'm sure we used to go to banks, we have a lot of walk-ins customers. Then it was all paper-based, right? Then it was from that it moved to online system, the branch modeling system came in. Then they made centralized so that all the people can go to different branches, everything was centralized. The third could be like mobile app came, so all people can operate the technology through mobile app, so it becomes much, much easier. So that's the fourth pillar is the future which we are talking about, AI. So when I say AI, customer journey enhancement, so through that also there are a lot of people are employing the technology using AI and ML in this thing. So this is predominantly the technology involvement, and then from the risk perspective, how the technology is helping the risk management. That's what we want to talk about is the risk is started from the historical data. So where initially there a lot of audit was very, very important for the organization, where from the historic data, they collect the data from the past records and then try to mitigate those risks. And second, then it becomes more vigilant. Then they took the current prescriptive where the mitigation started process. Third is the upcoming proactive. So then from the technology, having historic data and the current data, with that, then they had a proactive way of measuring that using technology. They have the user experience and then they moved on to the third level. The future is more predictive. Okay, so when I say predictive, I am sure a couple of days back you must have seen a news how the AI has helped one of the girl was about to commit a suicide, but I'm sure how many people have read that news, but it was quite interesting. So I want to bring that how AI helped that kind of a critical situation. So she was going to suicide, and she posted that into a Facebook or something which is in online. The moment it was posted, the AI immediately took that as a distress the lady. It intimated the police station immediately. The moment it was intimated to the police station people saw that distressed lady, immediately they went to they informed the nearest police station, they went and they saved her. It had happened, I think, a week back. So this is something very interesting case study which I want to bring, that AI helped people to secure their life. So to that extent, the AI has helped has evolved. So with this AI technology, I am sure a lot of risk can be averted, risk can be predicted, risk can be brought. So many things can be done through AI technology, and the organization can be protected through this. Okay, so we are talking about so many frameworks and other things, but at the same time, how are we going to choose the right risk management solution, which is very important. So the technology is going to be embedded in our risk department. The same time, the first thing is very important. We have to inclusive of risk management. See, today risk management, the CRO or the risk team is following with a lot of stakeholders within the organization to collect the data. So that's a very, very important to democratize. As in our panelist, somebody said that the responsibility, the 3 lines of defense. The first is the teller who is going to collect the money. So he should be responsible for that particular action or the transaction which is doing. So he should be knowing that what is that. So similarly, we need to democratize the risk process so that we should engage all the stakeholders, inclusive of all the stakeholders within the system, so that you are aware that the technology can be used properly. The second is we have to inform the senior management. So the leadership team is knowing that what kind of risk is there in the happening. The third is the risk escalation. So whenever there is a risk is coming, that escalation should automatically trigger based on the SLAs or the issues which is happening, which is high risk for me, which is low risk for me, which is medium risk for me, so that the management is clearly aware of what are the risks are happening in the organization. A third very important is also for comprehensive and flexible to adapt the evolving regulation environment. And also I'm sure the panelists, they said a lot of new regulation is coming, and now FMR is coming. Show cause notice has recently come in the RBI, so guidelines. How quickly we are able to adapt those process changes, that's more important. So we should have a comprehensive and flexible system for adapting the rules and regulation of the organization. And also Mr. Anup also mentioning about the BRE system. So when he said the BRE, how quickly he was able to change those rules and brought into in action. So that's where agile method is created. And very important is clear practice and communication. So you need to communicate to all the stakeholders so to have a proper streamlined communication within the organization. Another area of the growing stakeholders' expectation. See, on one side, there is a peer pressure on the business. So everybody is saying that on one of the questions also I saw, they were asking that I want to do the business. Somebody is half day, they are working for a collection, and somebody is doing business as well. So like that, there is a lot of pressure on the business. The other side, there is a pressure from the regulator, or regulators keep adding a lot of new regulations are coming in. Third, board also, we need to take care of the board whenever their visions to be taken care. And we should also align with the CEO's strategy for the growth and sustainability goals to be achieved by the organization. That's more important. Very, very important is the investors, how I'm going to protect their money. So that's also very important. Tomorrow you come with a lot of risk, and we cannot project to the investor and say that these are the risks which are coming, and how the investor is going to gain the strength or the confidence in the company. So that's also very important. On the other side, the customer, we need to engage. There is a lot of competition is also there in the market. Also from the, we will also touch upon very important point is employee retention, how we can improve the employees, cultivate their risk awareness to the organization, a lot of trainings to be done. And then also the competition we are talking about to tap. So here, very important, these are all the various things which are important in the risk stakeholding. At the same time, we are trying to integrate the risk management. So leveraging the data, as Mr. Anup also mentioning, that we need to integrate all this data from various touch points so that the data comes into one single ERM system, so that we are able to have the integrity, eliminate the manual entry into the system and prevent data manipulation. So that's very important. That's where the technology is going to help the risk department to ensure that data is fully protected, and also using such BRE and other technology, we will be able to achieve this. So that's where we are trying to align the business risk appetite tolerance mindset through various internal and external risks which is going to cause, which could be related to operational project costs, employee costs, this all we were talking about. And very important is data theft, or it could be related to the theft or robbery or fraud which is happening. That is also very, very important, that within the employee there could be a lot of frauds could happen. It all can be managed through this. So these are the 5-step process. I am sure this slide will, most of the CROs understand that it starts from your identification of risk, where you measure the risk, how you mitigate the risk, whether the risk has to be, what is the technique which you are going to use, whether you are going to accept it, avoid, transfer, or a control. And also from one of the panel, they were saying that for the crop and for the employees or for their customer, that was quite interesting, which I could see. That's one of the mitigation process, that they are tagging with the insurance company. So that's a risk transfer, we call it as. So very interestingly, so if somebody is fallen ill, or the crops are not, they are not able to get them because of climate risk. So they are getting the money from the insurance. So that way they are able to protect their investment. So that's a very, very interesting point which I have also learned today, that how the organization is proactive and mitigating the risks which they are encountering with their customers. Similarly, then, and it has to be continuously monitored. That's not that I found the risk and then, okay, I am having an attrition rate, okay, this month I am okay with this, but attrition rate could happen ever since the company is there. So you need to keep monitoring how my attrition rates are performing, and properly the reporting is happening in the RBI's things. So from the technology perspective, what are the offerings we can provide you? Is a complete operation risk management suite. Okay, so very, very important is your incident reporting and management. So when I say incident reporting and management, also I believe that in one of the panelists said that how we are going to get this incident, right? So they have 5,000, you want to include all the employees. So one of the case studies, we have already implemented one of the microfinance where there are 7,000 employees. Okay, from the 7,000 employees can report any incident in their organization. Okay, now when they say microfinance, what is the another challenge in the technology? We say all are not educated. So I know only Oriya language, I know only Tamil language, I know only. So what we came out with our solution is, we brought that solution into multilingual. That means I can put my incident or I can report an issue in my own language, in the way where I want to put it. The system, using the technology, what we have done is we do a auto translation into English, so that the risk department is able to evaluate, and the data comes in multiple languages, but end of the day the result is in English, so that risk department is able to evaluate the risk, whether you want to take it or not, whether they evaluate the risk and then they move into the different categorizations. That's a very important, because in microfinance we need to include all the people. This is the current issue, that many people cannot put an incident. So that's a problem which we try to solve for a microfinance industry. Then we have issue management and tracking systems. We can, from the incident reporting, then it gets into issue management, so that actions can be taken, the actions can be closed. so that till that time, because these two things are interrelated. Why? Because most of the microfinance companies, the robbery, fraud has to be reported, or there could be third party like insurance is also is coming to the picture. So many cases, there are a lot of incidents are open for quite long time, 6 months to 1 year or 2 years. There are court cases. So you need to track those issues. So we have this complete solution where the incident get closed and the issues can be tracked over a period of time. The third very important is key risk indicators. Okay, so we integrate the key risk indicator and the incident management correlates or works together to monitor the application. So one of the classic example to solve the problem, like many of the panelists were mentioning about business attrition, or it could be people attrition, right? So these are the two common issues which we are talking about. So how it can be monitored? So this key risk indicators are going to help through using our solution, where this can be monitored on a monthly basis whether how my attritions are going to work. And also it has got a business rule engine. With that we can have many parameters can be brought into various applications. It not need to be entered by us manually by the system. Directly you can fetch from your HR or from your LOS system, or it could be from your CRM system. So all this from different data points we can bring it, and then this can be automated through application. Another very interesting solution, branch approval. Again, branch approval is nothing but, I'm sure many of the microfinance companies will be having a PIN code based branch approval which is happening. So how I want to start a new branch in one of the location, but how I'm going to approve that branch, right? So in that case, I could see a lot of, I'm sure, third party data are available which they have from various sources, where you have PIN code related data, delinquency of the customer, or it could be many data points which you want to collect, the demographic of that, the climate related or agriculture, people, population, male, female. So there are so much of data available in that. So for that we can create some kind of a business model in which through our BRE, this can be automated and the branch approval can be done through the business rules. So that's where we have done a fantastic business rule engine, so that microfinance can ensure that their branch approval process can be done much faster in the application, and who has done the approval, when it was done, all those things can be done. And also, we were also talking about third party risk. The third party risk is vendor onboarding process. So when I say vendor onboarding process, is nothing but onboarding your new vendor to the deboarding the vendor. So entire this thing is also important. Then from the RBI perspective, we have done the complete vendor onboarding. Also IT outsourcing is a new regulatory which is also taken care. Vendor invoicing is also another product which we have done. Very important thing is all this vendor management system consists of one single system, because RBI says we cannot go to multiple departments for getting the data. So including the contract management to vendor risk assessment, everything is one single system. Then branch audit, policy exceptions is again, we have a different IFC, control testing, ISO audit, notice and complaints tracker. Again, complaints tracking is very important. So these are the things which we can do that. So we can give an end-to-end solution right from the consulting. Because of the time, I'm not going a little faster. So this is about Listen of Technologies. We have global presence. We have a lot of recent success where we have implemented in various microfinance, NBFC, and banks and all. Product advantage, we are very focused on risk management solutions. Okay, we have very good client engagement, and we have good leadership technology. So thanks a lot for any demos, any questions. I'm sure we are there.
Which are your partners using the product?
Here we have CAG is using Credit Access Grameen, Chaitanya Microfinance is using our solution, and then Satya Micro is using our solution. So Credit Access Grameen is one of the largest microfinance company. Apart from that, Axis Finance from the NBFC, Axis Finance, NSDL Payment Bank. Then we have international, one of the Saudi investment companies using our solution. So we have large and HDFC we have onboarded recently. So HDFC is using our solution. Quite interesting products we have. We help a lot of microfinance in building a lot of technology things. Right? So we are based out of Chennai, and our product can be customized. That's very important. So why? Because every organization has different processes, different way of looking at the risk management differently. They have different risk appetite. So that's the reason we want to be in India. We want to take care of our initiative of Make in India product. So that's where we want to help the microfinance company as well. So that's their idea. Because the large products, you need to adapt to that technology. So we understand the microfinance business and we help them. Thank you, sir. Thanks for this opportunity. I look forward to meet you all people. For any help, any support in technology aspects, I'm sure we can help you. Thanks a lot.
Thank you for this presentation.
Sure, sir.
Thank you everyone for your patience. Now we will break for lunch and request everyone to come back around 2:30 so that we can conclude the program by 3:30 today. As Anand from Spandana Spurti, Mr. Shashidhar from Subke, Mr. Krishna Chandran from Kasafi, Mr. Loyal Kodras from Bajaj Finance, Mr. Ashok Kumar from ICICI Lombard.
Okay, please sit down.
Please settle down. We are starting our next session on tackling emerging external risk leading to credit risk, role of senior management and chief risk officers.
Hi, good afternoon everyone. My name is Twixraj. I'll be the moderator for the session. I represent Dwara Research. I head one of the verticals called Financial Systems Design. And today there is a panel of eminent speakers who really don't need an introduction. So in the interest of time, what I'm going to do is going to delve right into the subject, which is external risk manifesting into credit risk. Now, I think all of us are familiar with external risk, and we understand that an external risk can manifest across the board from different parts of the world and from different pockets as well. How they enter into the system, how they enter into the business cycle can be of various folds and so on. And just because of the diversity of the situation, what we're going to do is restrict ourselves to business operations mostly instead of focusing on every other dimension like funding, sourcing, and so on and so forth. So with that, I am going to open the discussion. The structure of the conversation is mostly going to be some common questions for everybody in the panel, and then there will be certain direct questions to individual members. I'll start with Mr. Shashidhar. If you could help us understand what are exactly the major emerging risks, specifically external risks, and how do you think they're entering into and impacting credit risk overall?
Thank you. Thanks, Sa-Dhan. I think very pertinent session for the times that we are in. So I'll just break your question into a little bit more nuanced. When we say external, I would look at it external to the institution, external to the sector, and one level up, external to the geography that we operate, right? So I'll address the larger one, external to the geography, which sometimes can be a climate risk, which can impact multiple geographies at the same time. It can be a political risk that can impact, again, multiple districts, multiple states sometimes. So these are known aspects that we all deal with. And actually, if you look at microfinance as a business, it is mostly external risk that has started impacting us than all the operational and credit risks that we discussed. The operational credit risks are more newer concepts that we are learning, but mostly we were impacted by external risks. Market risk is another external risk. So these are larger strokes that happens, and we have gone through them. COVID is an external, larger, multi-geography risk. So all these things we've gone through. So I don't need to delve into that because we all dealt with it for a long time. Now external to the sector. So I want to bring in this aspect of invisible competitors that are emerging for us, and we all need to be very cognizant that, in my opinion, with all due respect of all the payment companies today, PhonePe, Google Pay, in my opinion, they are external risks for our sector. I mean, one can say that they are a competition, but they are also a risk because very good customers that have demonstrated excellent digital behavior in their past using these apps would very silently walk out of microfinance industry and become loyal customers to PhonePe once PhonePe starts giving UPI, credit on UPI. This is a risk for us because these are probably the best customers we would have had, because they have demonstrated not only very good digital behavior, but also the data that we have says that a good digital customer is also a good financial customer. It's very high correlation. If you are a good digital payer, you are actually a good payer too. And we end up losing some of these very good customers that we have nurtured for a long time to this external risk that is entering in the industry. No, I mean, risk competition, you can look at it. So that is one thing that we all need to understand, that microfinance sector is no more a boundary drawn industry, and we should not be happy that we are the only ones competing with each other. There are many players that are entering, and we have seen this. MFIs were NGOs, then NBFC MFIs, then NBFCs entered, then banks entered. So now there are all kinds of animals anyway already in the forest, but now we are also seeing people and animals entering from outside the forest. Now, last point, the institution, right? I would provoke a little bit on this, is that we are all subjected to the external risk of copying each other. This industry has a problem that we all need to address, is that we all do the same thing. Hence, we all suffer the same problem. That is very external to my company. If I am following a particular process that everybody else follows, then the customer that defaults to me, she defaults to everybody else. I think this is a risk that we all need to address, right? We have a business model risk that we all follow, we all go through. In my opinion, we are too much of a copycat business, which impacts us really, really badly when things go bad. When things go good, we all enjoy the benefits. When things go bad, we all enjoy I don't think anybody in this room will say that, hey, you know what, my collections are better than yours. More or less, all of us are in the same bucket. I think this is a risk that all individual institutions we face, which is external to my company, because I am sort of using everybody regulatory boundaries also as my rule book, and I'm kind of trying to do things that perhaps are not very individualistic to my own company. The day we realize that we are an independent entity and the customer identifies who somebody talked about, I think Sir talked about image building, brand building. If we don't do that, we will run into external risks within this room more than anybody else. So I just wanted to provoke that point of view, that we are too much of a JLG kind of a companies, all work together, do same thing, peer pressure and all that is also there in this room, which also need to be addressed to an extent. So I'm kind of diverting from the regular known external risks. I don't think that is much to be discussed about. I'm bringing out some of the aspects that are true to our industry, and we need to be honest that how much are we really independently assess our customers' risk, how much independently we identify the locations where we want to go, we follow each other's bikes, we go to the customer, same customer, we do everything the same. We will run into this risk that is, it seems internal, but actually it's bit of an external to our institution, but we are compelled to do things the way that we do. So I just want to stop there, maybe help others add something on this. But these are certain things that are creeping in. And we talk about money ringleaders and all that stuff. I think those are known things, and I would like to hear others' views on that. Thank you.
Right, thank you. I think it's a very interesting take insofar as, while the standard risks are pretty known within the group, and like you rightly said, that the biggest issues were demonetization, COVID and so on, and not necessarily some mass scale idiosyncratic risk propping up as such. It's also interesting how you're framing the subject insofar as it is external to what? Is it external to the sector? Is it external to India as a whole maybe, or the geography of operations? I would like to move on to Mr. Portis. If you could shed some light on how do we measure these, right? Because a lot of these are observable, right? Like all of a sudden, the Prime Minister gets up on the television and says from tomorrow onwards, boss, currency notes won't work. Now, sure, that's a risk you can't really anticipate, and that is an external risk indeed. But are there external risks that you think can be anticipated? How do we measure them?
Sure, why not? So just taking cue from here. So we need to understand that what was yesterday may not be tomorrow. You may be having new risks which were not pertinent before earlier, but now you are pretty much exposed to. But having said that, historically, what this sector faces, or the kind of risks this faces, that external events which become huge credit risks. Just to shed light, AP. When AP happened, 27% portfolio of the largest microfinance player, got pretty much written down. The second largest player, 50% portfolio was in Andhra Pradesh then. Okay, that got written. So then obviously you had other issues, small issues there coming in, demonetization, right? You had COVID. In between that, you had issues, local issues, which we don't talk often, right? A third party person comes in and makes sure that the whole 2-3 districts become negative in coastal Karnataka. Similar things happen in some parts of Maharashtra. Assam crisis. Okay. So what I wanted to say is, how do you measure them? The answer for that, and what you do to mitigate for that. The answer lies in having a very robust ECL model, expected credit loss model. Okay. There's a saying, right? You make hay when the sun shines. When you're doing good, you must, the organizations, particularly smaller organizations, medium as well as large do, because they have frameworks properly, good frameworks. You have to provision aggressively to have a proper ECL model along with the regular losses and which factors for your management overlay too. So the answer to the question when Prime Minister rises up one day and says that this notes will not work is you dip into that overlay particularly during that time, and that is how you recuse yourself. Okay. So and that is how you redeem yourself, and that gives you breathing space. Okay. Because if we are in a particular market where a large flood comes, like Lisa said in morning, a particular state, it impacts different players differently. Some players it may impact very, very badly because, say for example, someone like Grameen, someone like Muthoot, they have prominent portfolios in particular states. So the answer for that is, you take cue from history, what was done, have a very robust ECL model, wherein you factor for your regular losses, you have a very proper management overlay, okay, and you review it regularly and look at the market and how it behaves, and look at the events and incidents which happen. Because we are microfinance and we are operational risk heavy, right? We should accept that. Okay? That is the true nature, right? So, how many of the NBFCs are investing a little bit of money in finding incidents? What is happening in the ground? Okay? Do you have a proper second line of defense which is independent, not reporting to business, but reporting to your risk managers up there who are unbiased reporting, see, this is happening in this particular branch, this particular region, this particular village, or this particular state. So if those things happen and you have a framework that you get an incident, there is a particular time, say monthly, and those incidents have to be closed, they have to be resolved, and those incidents get reported to the management. They get reported into your risk reviews monthly which happen, they get reported into your risk management committees, and you factor for them. See, and do you really have to apportion provision for that? That is where how you can actually factor for credit risk, and that is the only thing which can protect you. And it's nothing to say that risk awareness is the most important thing. The organization need to have a risk awareness culture. In my previous organization, the very senior person used to say, we don't have only 100 risk managers, field risk managers. We have 14,000 of them because all of the loan officers were risk managers, kind of risk managers. They need to be aware what exactly in every transaction what they are doing, every village survey they are approving, every village survey they are doing, and they are saying, okay, this is a village survey, I am approving that. So, do you know what is the risk in that? Is a third party involved in that? Is a customer, would-be customer a major ringleader there? How is that geography? How is the microeconomy of that particular village? What it is dependent on? Is it dependent on particular crops which have failed drastically from last few years? Is it drought-prone area? All those things. And then take according decisions. Okay, and individual, when you onboard individual customers. So that is risk awareness at that level. Sure, you are big organizations right now can do eKYC. A lot of problems get solved of microfinance. There is a ghost loan and ghost customers. But having said that, you can't have a alternative for proper due diligence at the field, and you can't have an alternative for a proper incident management system wherein your independent teams report incidents and that all gets compiled and gets reported to the management. Thereby you factor in what is to be provided, and when you have good times, you need to have a proper management overlay, which thereby protects you when your next cycle comes. We are business prone to cycles are prone to come for us, and you can utilize those management overlays when you get cycles. I think I'll stop at this.
Right, thank you. That's very insightful, because you not only touched on, okay, let's start allocating capital and doing robust provisioning, but also what are the alternate systems that go beyond just capital management and provisioning. And that's very interesting. So what we'll do is we'll just switch gear and perhaps start thinking about, in addition to capital, in addition to ECL, are there any other approaches that you can think we may adopt? I think some of the examples that Mr. Pontus already provided are in terms of ensure that your boots on the ground are basically risk managers, or at least have that mindset that this is something that this is the problem that I'm seeing in the field, so let me just escalate it past the black post, right? Any other strategies that you would think that can be adopted? So let me start with Mr. Amit, and I'll request anybody else who wants to weigh in to also weigh in.
It all depends on the kind of external event that we are trying to address, because the magnitude of the event and then the extent how it is going to impact us as an entity will determine what will be the response. So basically COVID has taught us, because in microfinance, if we see a black swan event for a microfinance, the near approximate will be the COVID, because it drastically changed the customer behavior. So where GLG, which was the keystone of the entire microfinance activity, so suddenly we saw the change in behavior of the group per se. So and then even we saw a drastic attrition on the employee side also. So we have suddenly a new batch of employees who were not aware of how the entire microfinance industry works. So this is the kind of or the extent of impact that any external event can have. But then, as I said earlier, the nature of or extent of event can determine our actions. So what would be and is proper is to have an integrated approach where all kind of risks are assessed at one place and monitored at one place, and then how much impact at the entity level of each risk estimate is there. So based on that, we determine our integrated risk response also. So this can be a way where I feel the way to tackle any external event, and based on the risk, we determine our approach.
Great, thank you for that. So let me just ask a follow-up in terms of, could you give us an example where you think that there was a certain external event? I mean, let's keep the big ones aside of ASAP and COVID and demonetization, West Bengal also to some extent, I presume. But could you give us an example, perhaps, and this is for everyone, could you give us an example where there were certain risk events that you saw, and which strategies helped you mitigate those or early identify them and get ahead of them? If you could give us some examples that you may have encountered.
So most recent will be, and we are on records on the IR lending to NTC, the new to credit customers. And we were seeing, and I was discussing earlier, we were seeing some unusual bureau records also for a same customer from two different bureaus. One was having all the trade lines, the other one was having a -1. So, and then in case of any uncertainty, the best way is to be conservative. So we tried to be patient on that, and we took a position that we should stop to the new to credit customers for some time, and then monitor whatever we have lent, how they are behaving. So now we have tracked them for quite some time, and we see the initial the dips that we had seen in their repaying behaviors. We have now seeing a uptick in that. So now, based on the data and then the further analysis of their bureau behavior, maybe we may modify our response to that. So this was the most recent an external event that triggered us to take an action.
Right, thank you. Others, in case you want to share.
See, I think one thing we need to be very cautious about. It's easy to be risk averse, and perhaps we're all sitting here and talking about financial inclusion, and we may end up excluding some of the potentially very good but never taken loan, like NTC, for example. It's a good institutional policy, but is it serving what you are supposed to serve? Are you supposed to exclude an NTC customer because potentially they are seemingly risky? Or do you have to have processes that will help you evaluate that customer better? So I'll give you an example. And I keep saying this in many forums, that in microfinance we have this tendency to treat all customers with one brushstroke. We think all are same. And we apply the same process, same system, same people, everything is same. Now think about this customer base as multiple segments. Okay, there may be very, very low risk segment and there will be very high risk segment. Well, too high, you can eliminate them based on some data points, not because they're NTC, they're probably because of certain alternate data can also help you. But I tell you, there are at least 25-30% of the customers in every MFI's book that actually do not even require a touch point. You don't need to talk to them. You can literally give them a loan on their phone and you will just nudge them to pay on time. They will pay you come what may. The reason I am telling you, in COVID, is there any MFI in this country who reported zero collection efficiency? No. Everybody at least were at 20, 25, 30% in the peak of COVID. How did that happen? Customers looked for you. There were cases when customers came finding our loan officers and pay them in the worst of the time, because there are always good customers who actually don't need this kind of treatment that we give. So what I'm trying to say is, if we can actually do a bit of an analysis of our customer base and say, hey, 20-25% of them don't really need too much of a work. If we can give them convenience and the systems, I'm talking digital mostly because digital is the most convenient, and give them the right access and most convenient loan, they will never default. And if you can identify that customer through data point, you have solved 25% of the problem. Now there are roughly, I'm talking based on my data, so larger institutions have much better data. About 35-40% of the customers will be there who are generally very disciplined. They don't default, that's why we're all still talking about 95% repayment rates. We're not talking about 20-30%. We're talking about 5% problem, not 90% problem. So there are 40-50% customers who will pay you, but you probably need to remind them, or perhaps a visit is required. So there you need a lighter touch, not a high touch. And there will be some 20% customers who will require a lot of work. You need to not only do a lot of work before you give a loan to them, you also need probably to do a lot of work after giving a loan to them. You have to visit them, you have to collect cash, you have to make them sit in a group meeting. I'm talking about this whole JLG will probably apply to 20-30% of the customers, really speaking, today, with all the evolution that have happened by microfinance in the last 25 years. If you really spend a lot of time on the 25% customers, you don't need to eliminate anybody. I mean, of course, you still need to eliminate some riskier ones who may be intentional defaulters and all that stuff, but not because they've never taken a loan before. So what I'm trying to say is that if we can start configuring our processes and apply the right amount of intensity to each set of customers, you will not only relieve your staff from doing too much of hard work, your retention will go up, attrition will go down, and your customer risk will be more addressed because your delinquency resolution will be much higher because you're spending a lot more time on a delinquent customer than at the same time with every customer. So I just want to call to action right here that how do we look at our business today versus what it should be going forward. That's what I was questioning about business model risk, and this is external to us because a loan officer goes to the village and if he makes something, if he misbehaves with the customer of any MFI, none of the MFIs will be allowed into the village. They don't even distribute one MFI and the other MFI. They will not say, hey, X MFI should not come in. That's not what they'll say. They'll say, no MFI will come in. The reason that happens is because we paint everything with the same brush. If we start treating our customers like customers and give them the right treatment, then your institution will stand out. And perhaps some of these internal external risks that we're talking about will be addressed, and I think we can do a lot more inclusion than exclusion. This is my provocative point, but I think there is something to think about. Thank you.
I think I need because Sashi took it as an exclusion measure, MTC. Because before taking this decision, we just for this gathering, because it's a common problem which many of us may be facing. Before taking this decision, we engaged two major bureaus, and we showed them both the reports, and there are multiples, and both of them have no answers because some borrowers, one was showing some trade lines, some other was showing, and both were excluding some others. So in case of these kind of uncertainty, I think the better way was to go conservative, and then there is no one here to exclude anyone in India when the government is going for full financial inclusion. So I'll rest the case here.
Was it in particular geography?
No, sir. It was across the 21 states where we are operating, and strangely, both the bureaus, they don't have any answer. So typically, by just including one mobile number, the entire complexion of the report changed. So this is the extent.
So I think what's perhaps happening is there is an overlap, and the factor of exclusion may not be NTC, it just may be correlated to the NTC part.
Yeah.
So we can, in the interest of time, I'll actually move on to the other panelists if that's okay. I'll come back to you with the same question if time permits. So let me switch gear and ask, because right now we have been discussing so far, what are the internal processes that MFIs can do, right? So let's take a different lens, and I'll request Mr. Ashok to perhaps shed light on how do you think non-MFI, right, like say insurers or other third-party providers can come in and help mitigate some of the external risks that MFIs do face.
Thank you so much for asking this question. So, if you talk about especially microfinance industry, okay, it's been how you are trying to avoid risk since almost a decade onwards. The similar way, if you talk about the banca insurance, okay, if you talk about the insurance, okay, part. Earlier, used to mindset of the people used to be only to cover the life. Okay, now we have the people of mindset have been completely changed. Okay, we're talking about the microfinance industry. Today morning, I think a panel member also is discussing about the NatCat example, if we talk about. Okay, different products also we have been launching. Okay, banca insurance also completely evolving into different products. Earlier only life, only the discussion used to happen. Now they're completely coming to the different products. If you talk about the home insurance, which is everyone knows about the home insurance. If something happens to a particular individual home and people goes to that particular area and they have to survey, all these things used to happen. Okay, only in that cases what happens is used to be taken for a lot of time for clearing that claims and all. Now the NatCat and all these kind of insurances products we have been keep on launching the underwriters. What happening is in the IMD's report, okay, one example I'll give you recently, and also it has been keep on happening. If you talk about the Andhra Pradesh recently, there is a lot of floods came into the near to Vijayawada area. I don't know, it is approximate 20,000+ cases we are expecting a reporting. And prior to that also, if you talk about the Tamil Nadu, almost 13,000 cases were settled, okay, in this particular product, okay. And before that, it's just 6 months before, if you talk about one of the organization, we have settled almost 13,000 cases. Okay, these different products we have started launching. This is on the IMD's report. Let's say example, this NatCat product, which gives the pin code wise, how much area it is got damaged, and the IMD report will give it. According to that, we will settle the entire loans, whatever the sum insured which is there. We will not go in to get into the individual loan surveys and all. So that kind of products are started coming, and it will certainly helpful to the this industry to mitigate the risk.
Right. So I think then we are talking about broadly 4 categories, right? So what the first panelists are saying is basically we have to get smart in terms of due diligence, in terms of how we design our processes. Then we can basically ensure that we do proper provisioning, proper credit loss, and then you're saying that let's spend some amount of money and get the necessary protections on board, because until and unless we have those protections, we don't really know what's going to hit us, right? Alright, let me move to Mr. Krishna. So if you could help us, if you could shed some light on how do you think technology, because nowadays with the advancement of technology and specifically after COVID, what we have seen is there is this, not only after COVID but also after the RBI's regulations, I would argue that there has been this immense rise in technology adoption, right? So whether it's third-party players or just more comprehensive LMSs and CMSs and so on. Do you think technology plays a role or can play a role in terms of identifying or mitigating or designing these strategies to capture risk or to mitigate risk?
Thank you for that. My name is Krishna. I sit here representing Kerala State Association of Financial Inclusion Institutions, and separately I also run a startup which is like we are piloting a marketplace for microfinance. So we have used like a lot of technology for identifying some of these risks, and say some, I think Anup mentioned of data going out, right? Some of the things are like very easy to be implemented, wouldn't cost much. For example, like our customer's phone number, as a list, nobody would be able to see. If somebody wants to call a customer, like they can click, it will go to the phone, and for that individual customer, then they can maybe able to copy. But somebody can't download the list of customers and like pass it on to an external party for such an issue to happen. Then there are like now APIs available if we integrate looking at our device data. I believe like almost all of us would be moving towards that app kind of thing, internal app for the customers. So we can take the device data as well as the mobile number data and check lot of scoring mechanisms are available, which will help us to weed out high risk cases. So these wouldn't cost much, and like servers asking about like BRE, how costly it is, right? Like now BREs are available in SaaS model, like maybe it will cost 5 to 10 rupees per case to run that, and just like I think again I have mentioned here, I believe 25 minutes heat in your rule could be done, like utilize that, and these are all technology advancements people could utilize, not going to cost much, and bucketing, and then when we move to the next category, we should try to bucket customers while like taking in, as well as Shashidhar mentioned, right? Like we bucketing customers for the collection, and so bucket them so that you instead of painting everyone with the same brush, okay, you have to recalibrate your approach based on the bucketing of the customer. Bucket A is pretty good, like you don't have to follow up at all. Bucket B, you have your own you could implement your own follow-up strategy, but like maybe a call a few days back before the collection due date, somebody might trigger like 2 calls. So all this could be managed utilizing technology in a very easy manner. If you have the strength to build that in-house, build it. Otherwise, there are service providers who are offering all these in SaaS model. It won't cost a bomb. And maybe like somebody like Sa-Dhan, etc. Could, for the smaller MFIs, right? Like could talk to such players and get a better quote for everyone in the industry. Yeah.
That actually allows me to segue to the final question that I had for everybody. In the interest of time, I'm going to just limit it to the final question, which is, what do you think that SROs and other industry association can play a role? I think what you mentioned is the fact that, well, they can be an aggregator, of course, and the moment they do the aggregation, your unit costs are coming down because of simply aggregating the volumes. But any other thoughts, any other strategies that you would propose?
May I elaborate? Like, yeah. Thanks. Here, like, we were talking a lot about external risk. I've been, of course, I've been in the industry since 2007, and except like 2 like black swan events, like demonetization as well as this COVID, I seriously haven't seen a pure external event affecting the industry as a whole. And COVID as well as demonetization, it affects everyone altogether. Once you like talk, Lal was mentioning, right? Like you calibrate provision, etc. So once you document all the known risks and put a number onto that, okay, this is the provisioning, etc. Then that risk is known. You know how to mitigate that. Black swan events come which are not on that paper. We cannot really think through how to do that, right? Except having sufficient provisioning. The company that you mentioned, like without taking name, like who had 27% portfolio, they got saved because like it was like some lucky thing that IPO happened few months before the crisis hit. So they had the money to write off around 1,200 crores. So what I am trying to say here is we as an industry haven't actually learned much lessons from each of these crises. These crises are, since these are all industry members, almost all these crises are caused by us only. Without like giving loans without proper due diligence, being too aggressive in the field without having control mechanisms in place, etc. So if we are finding that okay, RBI new regulation is causing an issue because FOIR cannot be calculated properly because the income cannot be assessed correctly. RBI says 50%, but as an industry, if there are SROs available, SROs could come back. Now SROs have come with guardrails, right? So this could be reduced. Instead of 50 is RBI limit. Now the guardrails are there. These kinds of additional measures could be done by SROs because they know the sector better. Second is going to the public about microfinance industry, which cannot be really done by any smaller, like if you take the number of MFIs operating, like the smaller ones are the numerous ones. They cannot afford to give a paper advertisement or something like that about the industry to put it across. This is under function associations would have to do, educate. Maybe we don't have the budget of somebody like a mutual fund association, etc. But we should start thinking about whether it's a right time to start a campaign about educating the public about what microfinance is, so that when a political or other external risks happen, there are our stories already out there with the public, that somebody can also question, hey, why you had to take that money and give to that Binami ringleader? You weren't supposed to do that, right? So that kind of things we as an association we could do. And third, of course, the point I mentioned, association could aggregate the demand and bargain for better rates from a lot of service providers. So these are my thoughts.
Hey. Thank you. I'll request others to please weigh in.
Yeah. Just adding to what he said, and just like to go back to the genesis of microfinance, JLG. See, you may see a proper distinction between urban microfinance and rural microfinance. In deep rural India, that is the Bharat, it is still there where that is a place where microfinance has the reach. No one has been able to reach there. Okay, your fintechs or otherwise anyway. So there is a concept that in the leaders of microfinance industry, when you start a center meeting, there is a promise that if you maintain to the customers, provided you maintain credit discipline, we will give you a required loan as per your capacity when you demand, okay, as per your capacity. So as I said, don't brush all the customers with the same brush paint, because it's easier to do, right? You have to look through data, you have to understand, you have to segregate customers who are good, customers who are really, customers who are really causing trouble, because all the facets are there, right there. So once you do that, and then we get all the time this question that, okay, we opened the branch there, some MFI will be telling me, we opened the branch in X location. After 1 year, they're like in deep red. They come to a district meeting or something like that. Then the other microfinance company will say that, why did you open the branch there? It has been deep red for like 2 years now, those villages. Your bureau data may say something at a pin code level, but at a village level, at that particular area level, where is the data sharing among microfinance companies? That's not there. Okay. So other SRO has started a particular thing, there's a radar going on where we report incidents. But how many microfinance companies are reporting incidents in earnest? Of ringleaders, of third parties, of instigators, of campaigners, of people who are making this their money churning business. There is nothing, okay? So you need to have proper data, you need to have work on that, you need to dedupe where to go, where not to go. Once you open a particular branch, it's very difficult to close it. Everyone would know that. Closing it means you're losing the portfolio. So you need better data sharing, you need better risk analytics, you understand where you're going, and then segregate customers so that the genuine microfinance customer don't suffer because of the few who are fraudulent in nature anyways. Okay. This goes to the bureau too, right? And as he pointed out, we have taken up with the bureau also, to SROs also. There are bureau task forces also, as you would know. So they have to get their act together, right? So a particular Sita Devi, there may be 4,50,000 Sita Devis in UP. Okay. So we have seen cases where you have multiple voter IDs which pass Karza checks. And your trade lines come different. That is a basic credit risk, right? I don't know the credit line of my customer. I am seeing that there is a different obligation of that particular customer. Okay. So when that happens, and when some events come and some cycles come, organizations resort to desperate measures, like stopping a particular segment completely altogether. So that's what, adding to it, to his take that we need to have a framework. There are frameworks available there. RBI has been very clear on it. Okay. The operational risk resilience framework, which was discussed in second panel, I think it's very critical. All of the MFI should get their act together and start. There are like 7 techniques what you have to do, 7 tools which you can use, and it covers pretty much a lot of things. You have proper risk management strategies. You have to use them, right? And you have to make sure these things are all discussed up to the top. It is not limited to a particular secure designations. That's the job of a CRO, I believe. At the end of the day, the right information is reflected and shown to the senior level management. That is the job of the CRO. But the job of the SRO, I would say, is that get all the microfinance institutions, MFIs, NBFC MFIs, banks, SFBs, whoever is exposed here. Make sure that there is a common pool of data wherein you are able to tap and see, okay, this is the place where these things have happened. Still you want to go? It is your risk appetite. Go. That's fine. Obviously you'll get good customers there. You have the technology, you have the know-how to filter good customers, bad customers in those particular areas. The institutions can take a call. So I think that's where I'll stop it. It's a integrated approach, as the panel has already come in. There is not one point thing, yes. But yes, as I discussed, I feel that you need to have a particular buffer which you can absorb, when the going is not so good. Thank you.
Thank you for that. Any other thoughts on what you think SROs can do?
Very quickly on the SRO, I think since especially more addressing to Sa-Dhan, since most of the members in Sa-Dhan are smaller MFIs, right? Of course there are large ones too, but by numbers there are a lot. They may not have the capability to do a lot of things that we're talking here, technology, data analytics, AI. I think SRO/industry association can do a lot of work in terms of providing data insights more than what we get as of now. Because the industry's landscape is changing. It is not the same 6 months ago, actually. Last 6 months have been very, very turbulent. And I don't think it's going anywhere. But it's a lot of us are stressed, and I don't think we can invest a lot in understanding what's going on. So I think SRO can do a lot of work in providing a lot more cuts, a lot more slices of data insights for each of us to take right decisions. The other area where SRO can certainly add value is on business model innovations. I think we have not acted on that front. As I was saying, there is a lot of reason to look at the whole industry from a bit of a different lens, more futuristic lens, digital lens, and how can SRO/associations can help against smaller institutions to move faster in adopting some of these new age technologies, new business model innovations. I think that's where SROs can do a lot of work because it will help everybody else and make things better for future. So these are the two, other than the great things that Sa-Dhan is already doing, bringing all of them together in some of these forums, excellent work, but I think these are the two specific areas that I think we can add value, especially for the benefit of small and medium MFIs.
We use Sa-Dhan's district risk score, which is a great tool to assess risk at district level, and it goes into our decision making and even brand selection criteria also. Because we have built a model, internal model, which is on top of Sa-Dhan's district as well as some bureau scores. And then as mentioned, radar, which is very unfair. But two major pain points, which as an industry practitioner, I have seen, because I come from a banking background and this was a new industry for me. So I saw two major areas where, and that is very basic to the entire assessment. One is the income assessment that is done. So for the same household, lender one will have, of course, most of us tend to be around 3 lakhs, but the range varies from it can be as low as 1 lakh, 1.5 lakhs to 2.99 lakhs. So, but then if we can, as an SRO, if we can come up with some standardized assessment model, income model, because it can be based on, because internally we are devising, which is based on the type of house is there, so it is based on asset, but then it will be different for different institutions. So if it is from SRO, So then we will have a income assessment which is more or less pakka for the entire practitioners. Second is somewhere it was mentioned. So if we can have a directory of spatially erring leaders or the fraudulent players that are across the geographies in India, and if those come up for all the member institutions, then that will be a great help to the industry as well.
Thank you for the comments, Mr. Ashok, in case you want to add anything. Alright, so I think it's been a pleasure, it's been a great discussion. I'm going to just open it up for the audience. Unfortunately, I don't think we'll be able to take more than 2-3 questions given the time constraints, but open to the audience.
Yeah. I have one question to the panel and one suggestion to Sa-Dhan. Sorry. Recently, when I was in a meeting with the MFI, they were telling that Aadhaar duplication is a major issue. Then I said I don't believe that, and I don't think the extent can be so much. But they said you give me your you give me a photo box, we'll get your Aadhaar card. And 2 days ago, one of the chief minister of the northeastern state, he was telling in our state the number of Aadhaar cards is twice the population. Is it really a serious external risk to be taken into account by the MFIs and other even Bajaj and all, or it is exaggerated? That is one. Sa-Dhan, one suggestion. Today's risk management microfinance. See, I told in the morning also, about 25 microfinance will come under the mid-layer, contributing to more than 75-90% of the total business. The remaining 75 to MFIs are small in size, much below 1,000. I did not find any single session for them exclusively in this context. See, most of the discussions by large NBFC MFI, service providers of course. So at least one session you should have, you should try, convey, telling that risk management for smaller MFIs in microfinance. This suggestion and question. It's such a serious issue. Aadhaar.
So more than Aadhaar duplication, sir, we have come across a lot of voter ID duplications, which has become major menace because voter ID is the real ID through which most of the credit bureau checks happen. Aadhaar has not been so consistent because when Supreme Court has banned it, many years we have not used Aadhaar. Aadhaar is only used for identifying the customer, but credit bureau it doesn't work for us. So voter ID is considered most common, but that has become a big menace. And too many duplications, and voter ID duplication is doable, not as much as Aadhaar. So I have not heard of as much from the Aadhaar perspective, but ID duplication and using different IDs for different MFIs has become a problem. MFI, different customers, one they use PAN, other place they use voter ID, and third place they use driving license or something. Those issues are there, but I haven't heard of so much of Aadhaar duplication as of now.
I just
Yeah, you're right that there are no Aadhaar duplication, but fraudulent Aadhaar are available. There are people holding 4 or 5 Aadhaars at a time. But if they have a cross-checking with the
eKYC will resolve that.
eKYC will resolve it.
Yeah.
So but only the problem is that eKYC, only the larger ones are now able to do directly. But then now NPCI has come up with a eSetu app, through which they can do it. So the fraudulent app, Aadhaar can be eliminated. There are no duplication, I believe. But regarding a couple of other things, I really appreciate the suggestion which you gave about having a program, having a session with the smaller ones. Okay. And then, sir, income assessment, I fully agree with you. It's an area. In fact, during the last time also I was discussing this issue that how do we have a standardized model for this? And he has said and promised that he will help me out to develop something. In fact, we have constituted one working group involving some 4-5 major MFIs and We tried to start something doing on that, but unfortunately, it did not take much shape because some institution which we engaged was quoting a very high rate for developing a model. So we could not go further about it. But I think we should do something on that. Data sharing, data insights. I think, as you rightly said, Ananta, we have a district level as well as even up to pin code level, we have a data analytical report which most of the MFIs make use of for that purpose. But that's only an indication. Further thing has to be done. One more thing I thought of regarding the business model. I think Shashi, you raised a valid point. In the morning also I was trying to say that we have not moved out of that same model which has been practiced over the last 25 years. Just for the information of the audience here, we have initiated a small project to develop a new approach for a microfinance loan. Actually, we are doing it along with one company called Meadow Plus. It is for developing an emergency health loan. Especially, we know that health is an area which many times microfinance borrowers have a problem. They end up in borrowing from outside, all the things. Even if they have an insurance, if some emergency comes, they need to go around looking for the money. So we thought we can develop a product, and that product should be in a position to give a loan within 24 hours. So for which some assessment has to be there. So we developed an assessment tool based on a survey done. We did around a survey of around 3,000 people with the help of MFIs. And based on the data received from there, we developed a tool which can indicate whether a borrower has the capability of repaying back. Those kind of things, some indicators there. So a tool has been developed. We are in the process of running a pilot on that. So if that works out, I'm sure that can be even developed for any other product. It's not necessarily only for, because we don't have to wait for a group meeting, we don't have to wait for any other thing. Only by going, and these parameters are purely physical parameters which you can see and assess without any kind of aberration. It's a very objective type of thing. Anybody can do it. It's just like whether he has a Paka house, whether he is whether any aged parents are there, something like that. Some things which are very easily accessible. So we are trying to develop that, and I would request some of the MFIs sitting here are part of our project, and they would like to run this. Thank you.
Thank you.
Right, thank you. I think we are out of time. Okay, last question.
Good afternoon. Sir, in some states, these property banks are issuing loans, and one fine morning they are writing it off. So then these microfinance people, what they feel, that loan is given as microfinance loan in property bank. So these people want us to write off also. This problem is arising.
The specific problem, I feel.
I think that's an age-old problem. So the solution for it is, you build in risk awareness among customers. Your every center meeting, you are following a weekly, bi-weekly, a bi-monthly, a fortnightly or a monthly model. So the job should not be just go there, collect money, ask if someone needs a loan, write applications, if that is how in your LMS or in your paper, and come back. There should be a proper session wherein we are after all doing financial inclusion, right? We may be the only financial entities, microfinance I'm talking about, whom those customers may be interacting. They may not be part of a big formal banking setup. May not be, I'm just saying. So you need to, some institutions call it Jagrati, some institutions call it awareness. You need to emphasize on them that, your future growth, your children's future growth is linked to your credit assessments with everyone knows by the name of CIBIL. No one knows by CRIF or Equifax. Okay, your CIR will get impacted, and your discipline, if you are not disciplined enough, you're likely to suffer in the future. So if that thing comes out properly, and if you're able to build discipline, as I said, you will be able to have a good set of customers. That segment will grow so large that even when you get a cycle, even when you get an event, those customers are likely to pull you out. Some customers, you will have a credit cost of 2.5–3%. That is given, and your you are booking to it. You always are factoring in credit cost, right? You are having a credit cost. The fear is only that this credit cost may become 2x, 3x. Those are the customers who will prevent that from happening. So it is from us, I think. So educate them properly. That happens because the customers are not educated.
I have a alternate also to this. I don't think that any lender would like to just give a loan and write off just like that. It's their money and they don't want to lose the money just like that. Why don't we start including them into our industry? Introduce that cooperative bank to Sa-Dhan. They should be a part of larger network. It should not be. I don't think there is anything like a microfinance institution anymore. All of our lenders can give microfinance loans. So one is So that's what. So what I think is that we can start including them rather than seeing them as outsiders. Perhaps will help, and I don't really think that people will simply write off their loans just like that. There may be a customer may be making a reason, but why would a bank just write off a loan? They would.
Sir, it comes from the state government, so they want.
But even corporate, even you talk about public cooperative banks or private cooperative banks?
Government cooperative.
Government cooperative bank. Then that is about telling the customer what is what, right? That is a possibility.
That I can understand, but they are elected. In a street, if one or two people are loans are written off, then others will follow. They will come and ask.
Loan waivers are a bigger challenge, so that's a different topic.
And in fact, we're talking about this point taken. I think we will have to conclude the session. Thank you everyone for gracing this, and also thank you Sa-Dhan for inviting us here. With that, I'll close the session. Thank you.
Thank you, Dilraj and other speakers for an informative session. I would request Gigi sir to give the mementos to our speakers.
Let's stand for a photo. Please, sir. Hey, Karthik and Sri, please join. I think you missed it. Come.
And also invite Mr. Shomish there.
Shomish, after the white tag. Aja, yaar. Completely forgot about him. He's our SRO head, He's the one who is doing all this work. Come.
He's taking notes.
Come. Can you all be fitted in?
Yeah. Smile, guys.
At the end, I would request all of you to join here at the end after the summation. We'll all stand together and take
Just request. I will request Shomish sir for a vote of thanks.
So, good afternoon, everybody. Good afternoon. And I know we have run a little over time, but I think it's been a very interesting session for everybody. In fact, this is one of the few sessions where I've seen nobody really moving out of the room. There's been no one on the phone. Everybody's been here. It's full, house full completely. So I guess it must be really interesting for all of you, and it has been for us as well. So just to conclude, I wanted to say a few words, and I think one of the things which was said at the beginning was that this topic is the need of the hour, and someone used the word headwinds, and it's true that we've been seeing from some of the data that there is some stress building up, there is some delinquencies happening, credit costs are going up, and in fact, Sa-Dhan as an SRO is going to be meeting very shortly with the RBI, and I think some of the learnings we've taken from this room will be shared in terms of some of the good practices that is being undertaken by the sector with the regulators. So I think they will also have some comfort from the sector about what is going on. I think we mentioned at the beginning about some of the new guidelines that Sa-Dhan has just implemented just about a month and a half ago. One of them was the Conclave guidelines that Mr. Mamin was sharing in the morning. So I think this is for us a critical point. One of them is really looking at the risks building up in the sector. We've actually doing some kind of self-capping where we are looking at households and having indebtedness not more than 2 lakhs, right? And having processing fees within 1.5 lakhs, not giving loans to people of who are NPAs above 3,000 rupees. So these are some kind of there's an effort on our side to self-discipline, and hopefully we'll start seeing that these measures will actually play out. And I think we're going to be measuring this in the coming months. It's the early stages now. We want to go back to the regulator to say that we've done it on our own. The sector is mature and very responsible, and we are starting to see some positive measures taking place. I think some of you mentioned, and I think Amit was mentioning here about this effort from our side on the pin code analysis, district analysis. And it's true. I think we do our own risk scoring every month, down to district as well as pin code analysis. In fact, way back in 2019, I think 6 to 8 months before the Assam crisis, we had said that there's going to be a crisis happening, and it happened. The question is, we can come out with a lot of data, but ultimately the people on the ground have to really see the validity of it and act on it. So we are doing a lot of data slicing, and we keep improving on it. We are seeing signs of the last few months in Bihar, which is another area which may be overeating in some pockets. It's growing very well, nothing's happened yet. But is there already some risk building up? That's something for us to watch out for. Today's session on risk is along with a lot of things we've been doing in the past on HR, compliances, fraud. We'll be doing one on grievance redressal. And in fact, we come out with this best practice publications, manuals from time to time. We came out with one on governance, and it's all thanks to you, your expertise, the experts who come and share. And some of you mentioned about small MFIs. In fact, all of this helps all the new budding people who are coming in. This is really nurturing them into it. Some of the learnings we've had today, I think I'm not going to list all of it, but there were some common things which came up which you would have noted. I think we learned a lot about optimizing risk. We learned about the 3 lines of defense and how important it is that some of this percolates downwards. It's not just at the risk management teams, but right down to the frontline staff. We learned about operational resilience. A lot of speakers talked about training and spreading awareness to staff and also to customers about what risk is. A lot of people talked about data and technology and how it can be used to track behavior and how to predict risk. We heard a lot about attrition. I mean, this is really top of mind for a lot of people and how to prevent it. We heard some practitioners talk about what they are doing now in terms of scoring and other things to reduce this. We heard about the role of internal audit, that it is moving now to a more preventive form of department within organizations. And we also heard about how we've been conveniently separating risks into 3-4 levels, but how they're just coming together. It's very hard to separate them. So there's market, credit, operational, but there's also regulatory, technology, people risk. We heard about model risk and third-party risk, fraud. So there's a lot of things. And finally, in the last session, we heard how to manage this once it's already there, how to manage this risk and what to do from an SRO perspective. So I think there's been a really wealth of information that we picked up today, and I'd like to really thank, of course, all of you who've come, made the time, and who paid so much attention here. But mainly, I'd like to thank firstly the moderators, the speakers over here. Mr. Mohan is, I think, left here, but I'd like to thank Mr. Karthik, who was the moderator of the first session, Then, of course, Mr. Jagdish Babu, who's here, so and Vijiraj Bhattacharya. So, big hand to them for moderating so well, asking questions so wonderfully. Then, of course, our 15 speakers. I'm not going to name all of them, but thank you so much for the quality of the discussion and for really keeping us fully engaged. And finally, I'd like to thank our sponsors here. I think the chair is covering some of it here, but mainly, at the bottom, their associate sponsors, South India Finvest and all are covered here. But so Radiant Cash Management, Radiant Ace Money, Lissom Soft, Kasafi, and South India Finvest, and ICICI. Yeah. So thank you all for coming for your excellent presentations. And we hope to see you again soon. We will be having many, because many of our members actually wanted to come here, even though we've overshot the attendance. We were expecting 70, 80 people and there were more than 120. Many couldn't come because it was Kochi. And so we'll have to have another session maybe somewhere else. It could be Bombay or Delhi. So please come again and share again with us. But other than that, next month is our national conference. So we invite you all to come for that. That's on 23rd and 24th October. So thank you once again. We will be sharing some of the highlights of today's session once we have it. It's on video recording, so we'll share it with you. Thank you once again. Thank you. Bye-bye.